The Fed's looking right now at the tightening conditions and saying, yeah, it hurts. Yeah, it's painful, but this is a feature. It's not a bug. We're going to see more of it.
The Fed is willing to flirt, and other central banks are willing to flirt with recession.
Central bankers are finally being a little bit upfront about what they're actually having to deal with.
We're seeing this momentum where central banks have to go big because all of the big ones are going big.
The markets are starting to smell economic slowdown, which I think is a little premature.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Taking it back to the 1970s, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures are just about negative by 0.04%. TK leaving behind the worst first half for the S&P going back to 1970.
Memories like the corner of my mind.
That's what we needed.
John, it's the 70s. It's not. I looked at a quarterly chart today. Thank you, Barbara Streisand, for that. And the great Sidney Pollack. Guys, this is simple. I looked at the quarterly chart. Today is Calm Down Friday. Yeah, it's been ugly. But if you look at 1970, 1974, and on, there's been all sorts of quarterly measured pullbacks in the Standard & Poor's 500. Worse than are we now? We all remember 87. But then there's 03, 09, and just the pandemic. John, it's not that bad out there.
You've selected some pretty brutal years, Tom, over the last 5, 6, 7 decades or so.
Yeah.
I mean, come on.
It is brutal.
20,
this has been a brutal first half. I get that.
87.
Put it in perspective, and I thought Steve Stanley opening the show there with Amherst Pierpont had a nice frame of it, sort of a John Williams tone, while others, John Ferro, as you mentioned overnight, have marked down.
We're getting downgrades, and I think that's the new development over the last 24 hours or so, Lisa. Morgan Stanley, Goldman Sachs, Morgan Stanley and Ellen Zentner and the team downgrading growth. The Atlanta Now GDP cast, you know that one. Yeah. That's negative. Things aren't looking great on the data front.
No, they're not looking great. And if you look at the economic surprise index, you can see it's actually quite negative, and it has been for quite a while. And yesterday's personal spending numbers really did put a damper on perhaps the economic growth expectation, simply because people are pulling back. This is a sign that prices have gotten to a level where people are spending less on a real term. And that, I think, has got people's attention.
There's been this sneaky conversation over the last couple of weeks about the potential for cuts in 2023. Ellen Zentner and the team actually put that in the research. That's not the forecast. It's not the base case, but they acknowledge the potential. Cuts potentially coming as growth falls further below potential. That's the new development in the conversation recently.
And crystallizing it is Michael Burry, the famed short seller, where he came out last night and said, next up is earnings compression. So maybe halfway there with respect to how much the stock market has sold off, given that we've already had the worst first half going back to 1970. The concern is we could get that gloom persisting into the second half, despite some of Tom Keene's.
It's to balance you out, Tom.
John, I went back to 1947. I looked at the smiles we gave to one another for the way we were. Guess what? Things get better rapidly.
I don't disagree.
High inflation.
I don't disagree.
We did it twice, and particularly going into the Eisenhower deflation of 1952. Things can change here. Okay. I would suggest we need to be more optimistic.
Oh, do you?
From the corners of my mind.
Okay. Are you just reciting lyrics, or is that just something you want to say?
No, it's a great movie. I mean, come on, the shot at the Plaza with Bob Redford and Barbara Streisand is just iconic.
I'm going to give Brammer the final word here.
Please.
I'll just say, if you want a history lesson, Jim Reed of Deutsche Bank gives one, saying that 10-year treasuries just had their worst first half since 1788, just before George Washington became president. That's the historical moment that I'm looking at.
Are you suggesting Jim Reed might be a better historian than TK?
I'm just providing a little historical tidbit.
Does Jim Reed do movie quotes and lyrics, though?
No, he did not.
Exactly.
John, what David Wu's going to suggest is extend the x-axis to get perspective.
Oh, dear. What a start to this show. Futures down about 1/10 on the S&P. On the Nasdaq 100, we're down a little more than 1/10%, leaving behind the worst first half since 1970. Yields down by 3 or 4 basis points. TK, this is a development. Last 4 days, Treasury yields lower. It's a break of 3%.
Yeah, it is.
297.59.
Yeah, yield is where you see it. I'd also note that EM unravels, particularly EM as well. But, John, what's so important to understand is it was also simple then. And you're
I'm going to stop talking to you if you're not careful.
You're going to see all sorts of downgrades.
I've got to get
this
two or
weekend.
two or three
Everybody's
ads.
going to adjust over the long weekend.
Okay, let's hope you adjust over the next couple of minutes. Lisa, sub 3% on a 10-year.
Yeah, that sounded like what I say to my kids. If you don't stop it, I'm going to stop talking to you for a little bit. Today, the ECB's net bond buying program from the pandemic is set to end. I am watching this because of particularly the guidance that we've gotten from Christine Lagarde, from others on the European Central Bank, about how they're going to deal with the peripheral bond spread, how they're going to deal with 10-year yields in Italy, given how much they blew out just a few weeks ago. They have come in dramatically as people take a look at the possibility of flexibility with the reinvestments. When do we get more guidance? When do we get more of a sense of how they're going to do that? At 10 a.m., this is the data dump that we're watching, or I'm watching very closely. John, I know you are too. And Tom, U.S. June ISM manufacturing data, as well as U.S. May construction spending. How much do we get ongoing weakness in manufacturing? Even if the input prices are coming down or softening or even staying the same, how much are people making less stuff because people are buying less stuff? And if you take a look at the economic surprise index, it is absolutely rolled over, and it is near the lowest levels that we've seen going back to 2019, meaning people keep being too optimistic about how much growth there is in the economic metrics that we track. And today we get U.S. auto sales with GM and Toyota reporting at 9 a.m. and 10:30 respectively. How much do we see a stabilization, a much lower level of auto sales, given that some of the inventories are being worked out? However, still well below that 17 million average that we saw in 2018 and 2019, with the expectation around 13 million, John.
Lisa, thank you. Let's get to David Wu, the CEO of David Wu Unbound. That sounds exciting. David, great to have you with us on the programme. These comparisons to the 1970s, David, what's the biggest difference between now and then?
Actually, I mean, obviously the big difference is that in the 70s, the work, unionization was much more basically widespread. But I think COVID has actually more than compensated for it, because I think COVID has actually made labor supply somewhat less inelastic. Simply because, like, all these people who've now basically spent 2 years with their family, their priorities change. I think this is the reason why quit rates are all-time high, is because people have decided that there's more to life than work. And I think that is a huge headache for the Fed.
David, wonderful to talk to you. Let's do it longer next time. David, I'm going to cut to the chase. The single elephant here is the huge fiscal impulse that we saw in the pandemic. How long will it take to trail away, to diminish that fiscal impulse?
I mean, Tommy, you, by the way, love coming back to the show, but I just want to say this. I mean, first of all, there were 3 rounds of fiscal stimulus. I think the first 2 were justified. The third one that was unleashed by Biden at the start of 2021 was not only wasteful, but was completely unnecessary. Because by 2021, the economy was coming out of lockdown. Vaccines were becoming widely available. That was political opportunism at its worst. At the same time, of course, the Fed went on printing money for a whole entire year in 2021. I think the issue here was not the stimulus that was deployed in 2020, but was rather in 2021.
So, David, what's the big takeaway from the first half that gives you some direction and some conviction heading into the second half?
I think for me, the first half of 2022 was all about scoring own goal against ourselves. I think the total economic war that basically the West and America in particular have declared against Russia is hurting the West more than it's hurting Russia. And I think from that point of view, in my career, 20 years, I've never seen anything like this. You go to a war in order to win, not to score against yourself. And I think to a great extent, I think the reason why the market is only belatedly coming around to realizing we're going into a recession is because market didn't understand the economic impact of these sanctions.
Still trying to work it out now. David Wu, thank you, sir.
Thank you.
A longer conversation next time for sure. David Wu of David Wu Unbound. TK, we're still trying to work that out, aren't we? And what it means particularly for Europe, that downgrade from Morgan Stanley and the team, with Ellen Zettner leading the way for US economics, that was off the back of the recession call from Morgan Stanley on the European desk. That's what's going to start to eat into things.
It is normal and healthy to have a recalibration, and events will take over. You're going to see corporate cost cutting, corporate adjusting. You're going to see governments make some adjustments. And John, maybe the concept of June that we haven't talked enough about is this concept of front loading. You're going to have a strategic desire. Let's get it over with so we can move on. And that's what the market will expect out, is where are we when we move on?
Well, let's talk about the struggle that corporations are having right now to come to the credit market. We need to talk about 2 things. 1, the price of credit, and 2, the supply of credit. Let's talk about the latter first. There's a struggle at the moment, Lisa. It hasn't slammed shut, but the primary market has been really, really slow over the last month or so. The team here at Bloomberg, the slowest June since 2010 for the high-yield credit market. That's notable.
Especially given the fact that you've seen more deals pulled than the entirety of 2020 during the height of the pandemic. What that means is companies were planning to come to market, planning to sell bonds, and they withdrew those deals because they thought that they were not going to get the levels that they needed and that they wanted. This highlights how much companies don't need the market yet. That is why we're not seeing credit distress. What happens when they do?
John, I would note this, the clarion call of this week is how spread widened out. Investment grade and high yield spread with a vengeance widened out. That's maybe the singular feature of the week.
I couldn't agree more. You just wonder where the tipping point is for this Federal Reserve. It's clearly not here.
Well,
it was
okay.
this place where we're at right now on price, very close to it on the supply side. That was the story at the end of 2018, and they backed away. They're not this time around, so I wonder where the tipping point actually is.
John, I think the tipping point is really key, and I would go to this strange phrase, reaction functions. Mike McKee mentioning yesterday. Over the weekend, John, you're going to be partying like a monster. I'm reading 37 pages of Blanchard, Ghali, and Mankiw. And what they talk about there is as you bring down the inflation rate, and let's be optimistic that they can begin to do that, where do you get to those tipping points along the way? And it's plural. There's a number of points that matter. My amateur take is 5%. Really matters when we get there.
High yield spreads right now, 550. Lisa, we talked about late 2018, it was a problem. 2020, it was a major problem. Right now, Mike Schumacher of Wells Fargo, I think, quote of the week, this is a feature. It is not a bug. We're going to see more of it. That's his view. It's others too.
We need to see markets slow. And the only mechanism or the main mechanism the Fed has to slow markets and slow economic growth is by tightening some of these financial metrics.
John, we got over
the exact point.
John, we got over 1974. Okay, Pittsburgh Pirates, Barbara singing. I mean, what you got to remember, John, it's the laughter. We will remember.
You're going to sing us out?
I'm not going to sing us out.
Go on, sing us out.
Come on, it's not as bad as 74, 75.
Can you imagine waking up to
this?
It's
not as bad as 70.
I think that's what everyone's
It's not as bad as 1987,
heading down to Wall Street, you turn the
recovery.
TV on and Tom's singing at you in a tan suit and a bright green bow tie.
That's too painful
Come on.
to remember.
This is painful. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Inflation in the Eurozone rose higher than expected to a record last month. Consumer prices jumped 8.4% from a year ago. Once again, they were driven by soaring costs for food and energy. The European Central Bank is expected to raise interest rates this month for the first time in more than a decade. The coronavirus has returned to this Chinese city where it first emerged. 2 cases were reported in Wuhan, the first ones reported there in more than a month, and they came just days after President Xi Jinping's symbolic visit, where he reiterated the country's pursuit of zero-tolerance pandemic policy. Iran says it's ready for new indirect talks with the U.S. to revive the 2015 nuclear deal. The statement came after the latest round of discussions ended in Qatar after failing to make significant progress. Donald Trump pulled the U.S. out of the agreement back in 2018. The Biden administration wants to renew the deal, which limited Iran's nuclear program in return for easing sanctions. In Russia, a trial begins today for U.S. basketball star Brittany Griner, who was jailed more than 4 months ago on cannabis possession charges. The 2-time Olympic gold medalist was traveling to play for a Russian team. She could face up to 10 years in prison. The Biden administration calls Griner wrongfully detained. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
All the Gulf states are meeting. I indicated to them that I thought they should be increasing oil production generically, not to the Saudis particularly. And I think I hope we see them in their own interest concluding that makes sense to do.
That's the President of the United States. A busy week for him on the international stage. The next stop, a little bit later in the next month or so, will be the Middle East. From New York City this morning, good morning with Tom Keene, Lisa Abramovitz and Jonathan Ferro. Futures kicking off Q3. We're negative 1/10% on the S&P, leaving behind the worst first half since 1970. Bonds, what a range for 22. We closed out 21 sub 150.
Stunning.
350. We got close to that level on a 10-year in the last couple of weeks, and then we've backed away over the last 4 days. And I think the last 4 days are instructive. We're down 5 basis points to 296.49 on a 10-year. Tom, going into ISM data a little bit later this morning.
Yeah, I agree, Johnny. ISM data, which you're a big fan of, I'm a big fan of today, too. John, we got to stop here at 296 10-year yield. I mean, that's shocking. That is a compression of the yield curve.
Breaking down. Tom, you started the show by saying things aren't as bad as they have been in the past, and some people might agree. Mohammed writes in, Mohammed Dalarian, asking the following. Tom, is it as bad as Game 6 of 1986?
Yeah, for those of you
in the World
international,
Series?
this doesn't need any American translation.
Did his Mets beat your Red Sox?
Yeah, Game 3 was pretty bad. Lenny Dykstra hit the ball out off Oil Can Boyd, and that ball has never come down, John.
He's coming up a little bit later,
It
Tom.
reached orbital velocity somewhere over Everett, Massachusetts.
Mohammed's going to join us at 9 Eastern. You've got a message
I
for
didn't
him?
know that. On your other property there.
We'll be doing that on Bloomberg TV, going into the opening
He
bell.
gives me no love. I get nothing from him. Closing down in Joyaslava last night. Maria Tadeo and Amory Horton. Tadeo can't get out of bed, but Amory Horton is here after watching Fuego at Joyaslava in Madrid last night, and we pick up the pieces. Amory, I want to go to the other side of the world. The President of the United States will return and witness President Xi in Hong Kong in the absolute shock of what has happened across the arc of the last 25 years. What is the distinction between the Biden and the Trump policy on China?
Well, at the moment, not much. And you saw this really in the campaign trail, both Biden and Trump, seeing how this also was polling with the electorate, wanted to talk tough on China. There's one issue at the moment that this administration, we're still waiting for an answer on, and whether or not they're going to lift some tariffs from the Trump era on China, and that's because some economists think it can ease some inflationary concerns. But for the most part, they have stuck with a lot of the policies President Trump have put in place on China. There's one maybe potential nuance in approach, and that is President Trump really took a unilateral approach when wanting to combat China, while President Biden really relishes in this multilateral approach. He was just on a trip recently in Asia talking about this, and now he was at the G7. They discussed China, and also for the first time in the strategic concept here in Madrid for that NATO document, they call China a systemic challenge. A lot of that is being driven by Washington.
In the blur yesterday, we did not have time to speak of the symbolism of the leadership of Japan, South Korea, and the United States of America meeting at a NATO meeting. Let me ask the dumb question this morning. Is Japan and South Korea, do they end up joining NATO? Is that even possible?
It's a good question. At the moment, no, it's not on the books. We did just see at this NATO summit, a historic one with Sweden and Finland joining. But obviously, this goes to show where the NATO alliance sees potentially their future threats. And it's very telling that you have Japan and South Korea discussing all of this with the NATO alliance. And I would say key, and this is a exclusive Bloomberg reporting a few weeks ago, the way the Chinese military is starting to talk about the Taiwan Strait is very different language-wise than they have done so in the past, say 5-10 years ago. And that is that now they are asserting more than ever that it is not international waters. I asked Admiral Kirby about that exact question here in Madrid, and he said that's actually absolutely not true. These are international waters. We will continue to sail through these international waters, but clearly this is going to be a growing problem and is clearly a growing concern for not just Washington, but NATO capitals.
And Marie, from the international considerations to the domestic ones, Joe Biden coming home to a July 4th where there's going to be a record number of drivers out there, people experiencing a lower pain at the pump, but nonetheless near record highs. Saying yesterday, President Biden, that he wants people to expect to pay higher prices as long as it takes. How different of a shift is this? Basically making it a nationalistic push, saying this is part of the war against Russia, that we have to accept these prices.
I think the president has been saying this all along, but maybe not so directly. It's why the administration has been trying to call this to the public and explain to the public, quote unquote, Putin's price hike. Now, we know some of those inflationary concerns, and this administration was asking OPEC in August of last year to produce more because they saw some of these headwinds come down. But there's no denying that Russia's invasion of Ukraine has exacerbated that problem. And what are we seeing this morning? Russia had a decree out about the Sakhalin 2 terminal. This is really going to be a gas issue. But what it shows overall is that expect more volatility in this market.
Anne-Marie, thank you. We'll catch up with you and Maria Tadeo in the next hour. Looking forward to that for a whole bunch of reasons, AMH and Maria Tadeo. Look, Lisa, when it comes to foreign policy, it seems to me that Russia is just taking the lead on absolutely everything. And the administration is willing to compromise other foreign policy goals because of the problems it's causing at home. It's awkward, and I choose that word and you can choose another one, to hear the prospect of Chinese tariffs being removed from an administration who is also accusing China of genocide. It's beyond awkward. You can choose your own words, Lisa. That's problematic for a lot of people.
Well, it's coming at a time when the political calculus has also shifted, where people want to do the right thing and sort of cling to these ethics, but they're also facing off with bills that they don't want to or cannot pay. And that has been the main political calculus right now. The reason that it has not gotten passed earlier, these tariffs haven't been lifted, highlights how tenuous politically it is to go against some of those really pretty harsh comments earlier, John.
I'd be very interested to see what happens with the Saudis as well, Tom. There's been all this talk about this administration asking them to pump more. The president was hesitant to confirm that in that news conference yesterday.
Yeah, that's the exact word, John. Nice catch there. I heard that, John. And hesitant is the right word. What concerns me, John, and we saw this with his energy czar, Amos Hochstein. We hope to speak to him next week in Washington, is, John, they're focused on oil production, not distillates. Every pro I talk to, including the great Javier Blas, says that they should focus on distillates. And they're not.
And the problem with refining capacity, Tom, and let's be clear about that, that's not something that's easily addressable anytime soon.
John, ruble, biggest surprise from February 24th, 41% strength.
I'm with you, Tom. I'm with you. The president said at the news conference yesterday, and I paraphrase, that they wanted to hurt Russia and not hurt their own people at home. And Russia, if you just look at the crude revenue, the energy revenue, the ruble, Tom.
The fangs. It was all so simple then.
You're going to keep this up?
It was also simple.
Can't wait. If you hear any songs from the 1970s on this program today, it's Tom singing. Please stick with us. We'll fade this mic. Futures down just a little bit on the S&P. We're down a little more than 0.1%. On the Nasdaq 100, we're down by 0.2%. We never fade this mic. On the Russell, we're negative 0.16%, the worst first half on the S&P since 1970, kicking off the second half and the third quarter. And I want to think about the range we've seen on a US 10-year for the year so far. Sub 150 to close out 21. 350, we got close to that level in the last couple of weeks. We've backed away since. Over the last 4 days, yields lower, down 5 basis points on a 10-year, now sub 3%, 296, 67, and 2K. The data is speaking to that move. The data hasn't been great.
Yeah, the yield space, I think, has given us a lot of information this week, John, and all the uncertainty out there and the silly guesstimates about recession, the magnitude of recession, all the different opinions. All we've got left is to look at the data, and we've each got our favorite data points, but I would say we've gotten more information from fixed income this week than any other group.
In credit too, and the stress we're starting to see. And I think, Brammer, we can use the S word, can't we? We're starting to see just a little bit of stress.
I think that that's fair to use, especially because liquidity has been so poor. But I want to push back against not the optimism, but just sort of the faith that, Tom, you're showing right now that we're going to definitely get a rally just because, or that things aren't that bad and that people are just over gloomy. People are concerned, and they are concerned about a Fed that is going to go hard. John, that is by design. And to that point that we were talking about earlier about Mike Schumacher, they want to see the sell-off deepen in order to affect the change that they need to see with inflation.
So there's two different ways of looking at it. One, yes, you could see the sell-off deepen, or it just caps the upside. They're the two different ways you can think about it, but I'm with you for the next several months. This idea that we can get an easing of financial conditions and the Fed would be okay with that, I think that's an uncomfortable position to be in at the moment, from my perspective. And I think David Costin of Goldman shares that view as well, Tom. I caught up with him yesterday, and it's essentially what he said. We've basically got a cap on the S&P of about 4K through the next couple of months as we try and work some of this out, because this Fed wants tight financial conditions.
I have great respect for someone like Mr. Costin or Ellen Zentner, Morgan Stanley, and the 47 other people we talked to, that their timeline is 3 to 6 months. I'm going to give Zero Hedge credit. I can't remember where I saw this, but if you extend out from the gloom over 6 months, over a year, if you go out 2 years, the fact is you see a recovery. When you're like in 1970, when you're down and out, when you're on Wall Street and there's a bear market, you could find the bridge over troubled water.
I'll make a serious point as you try and slip in some more lyrics and quotes. Christian Muller-Glissman agrees with you. Published over at Goldman in the last 24 hours. The near-term view, very defensive.
Yes,
the 12-month view, a better view from his perspective in this market.
Yeah,
There's a range of views out there,
Christian
Tom.
likes ABBA, so we're not going there.
Please don't go there. Let me finish on this in Europe just briefly. CPI, upside surprise, again, in Europe. 8.6% on the headline inflation number, in line with the US. But look at core. Core slipped back just a little bit. It's sub 4%. So how much has changed for the ECB, Tom, today? I'm not sure a whole lot has changed for the ECB today compared to where we were just yesterday.
Into our 4-day work week next week, this is key, the relative move of price change. Right now, we're going to get a brief on this. Sarah House with us with a movable feast, a senior economist at Wells Fargo. Sarah, I don't want to front-run Wells Fargo notes, but what's the vector, what's the tone and the magnitude of change in your forecast for the GDP of the American economy?
So I think what we learned this week is that the consumer is on somewhat more fragile footing. So we're seeing cracks emerge in their spending patterns where they maybe don't quite have the fortitude to spend in this inflation environment than what was reported in recent data prints, where we did see some pretty notable downward revisions. And I think overall, we're looking at an economy losing momentum faster than what we anticipated. So right now we have a recession call for beginning the first half of next year, but I think if anything, the data shows that timing looks like it could be even sooner.
Does nominal GDP, the animal spirit that matters for businesses, does it come down as well? I mean, does inflation stay elevated and give us some false comfort, or does nominal crush down as well as the movements in real GDP?
So I think with the inflation environment, we don't think we've seen peak inflation yet. So we think that's probably more of a story for August or September. And so that's going to keep some of the nominal numbers elevated, even as we see real growth slow. But I think when you get to the fourth quarter of this year, you will see a more material slowdown in nominal GDP coming both from some disinflation, not a lot, but also that weaker growth profile.
Sarah, where is the inflation going to come from if we have not seen peak inflation yet?
So I think there's still plenty of pressure coming from food prices. Yes, we're seeing more moderate gains, but they're still pretty hefty. We've seen food inflation rise over 1% for a number of months, and so there's still plenty of momentum there. We're still seeing goods inflation, so it's not rolling over quite as much, even as you do have anecdotes of inventories beginning to pile up. But I think the real story is services inflation. So we haven't seen services inflation peak yet. A lot of that's coming from housing, but it's not just housing. So I think there's still some upward pressure on things like travel prices, but it's also some of the more mundane services, the medical services, insurance, that I think can still support higher inflation over the near term and keep that headline number from rolling over quite yet.
And this is one theory for why the Fed is going to go much further than other regions, just simply because they are facing off with service-based inflation that exceeds right now the weighting of certain goods inflation. So when we talk about the disinflationary force from oversupply stemming from the undersupply 2 years ago, that's going to help other regions in the world more than the United States. Can you give us a sense, though, of how close we are to that oversupply, especially as the likes of Micron come out and talk about much less demand for chips?
Yeah, so I think we'll certainly see that in the goods space more. As I mentioned, we've already seen some anecdotal reports of inventories pile up. We haven't seen that in the broad economic measures quite yet. There's a little bit of a lag there. But when it comes to goods inflation, that's only about the core numbers there. It's only about 20% of the index. So you're going to need a lot more than disinflation in goods. You're going to need outright declines to really help bring inflation down. Now, we've seen supply chain stress ease up a little bit. So supplier delivery times come down, shipping costs come down, but they're still at very elevated rates. And so I think we're far from the all clear. And so we're not going to see that immediate relief.
I'm just on the Bloomberg looking at the Atlanta Fed GDP Now GDP forecast, and we talked about that a couple of times this morning. Sarah, when people like me bring that up, can you explain what we're actually talking about? What are they tracking and how accurate is it?
That's an important question.
So this is tracking the data we've seen to date. It doesn't make assumptions about what might happen in some of the June data, which we have yet to see. It's really just the face value of what the latest data prints and what the momentum are seen there. I think an important aspect of the GDP number that they're tracking for Q2 is that, yes, we're seeing a more market slowdown in consumer spending. We're certainly seeing some more weakness in real investment across equipment, across residential, but a big drag there is coming from inventory. So we've had the two biggest quarters of inventory build, and we're still adding to inventories here in the second quarter, but it's just not as fast as pace. And so that's a huge reason for that negative number.
Last night, Sarah, out on Twitter, Claudia Sahm, the acclaimed economist, and of course the Sahm rule on labor and employment in slowdown, was heated that Atlanta GDP is not capturing a fully employed America. Do you see labor breaking in the third quarter of this year?
So I see the labor market weakening, but I think we're far from the bottom falling out on the labor market. And I think that's an important distinction when we talk about whether we're potentially in a recession now is, yes, we've seen a negative quarter for GDP print. It looks like Q2 is tracking negative. But if you step back and you look at some of the more nuanced data, so looking at more of that NBER criteria that looks for that widespread decline in activity, I don't think we've seen it. And such a big portion of that is because we're still adding jobs at a tremendous clip. That's keeping real income, less transfers, still growing positively, even as consumers have pared back their spending a little bit. And so I think that labor market aspect is so important in short-circuiting this talk of recession, where if you're adding jobs, that's helping to your income picture, and that helps keep demand from falling too markedly.
So Sarah, just quickly, in Q1, we sort of explained away the negative print there by talking about inventories and the trade data and all of that. Do you expect the same story again in the second quarter? Do you anticipate a negative print, but something people will ultimately explain away?
I think you can still explain away some of it, but I think if you look at the final demand to domestic purchases, no doubt we're seeing a slowdown there. So I think it's exaggerated weakness, but we're still seeing the economy weaken here in the second quarter and into the second half of the year.
Sarah House of Wells Fargo. Sarah, thank you. These are big, big issues, particularly what's happening in Europe. And I think you can explain away the trade story. But Lisa, ultimately, the trade story does matter, because if you've got international demand that's softer, weaker, you're going to see some kind of spillover. And I go back to the Morgan Stanley call yesterday evening from Ellen Zentner and the team. Really, that built off the back of the team over in Europe forecasting a recession for the European economy, and ultimately concluding some of that's going to bite into what happens here stateside.
Yeah, that's going to have to be the case. And that's one reason why you have companies that are multinationals coming from the U.S. talk about the dollar and the strong dollar as a headwind. Is it a headwind because of the potential lack of competitiveness when it comes to exports? Or is it because the weakness is what's causing it? And so there's less demand on the overseas side. And frankly, how much can we actually get Europe avoiding a recession in light of what we're expecting to see with the gas prices?
Oh.
I mean, that to me is a crisis that we're going to be talking about for the weeks upcoming.
They're in such a sticky spot. They've got all this upside risk on the inflation front, all this downside risk on the growth front. And Tom, they're looking to move gradually with interest rates. Inflation's north of 8. Just think about where the calendar is for this ECB. They've got a couple of meetings, one in July, another in September, then you go back into the end of October. So Tom, you can have a situation where this ECB maybe gets back to zero or just above before October time, Q4. That's tricky.
I'm going to use the thermometer, which is known as foreign exchange. And I'm sorry, right now, foreign exchange is front and center. I believe we've got Jordan Rochester coming up. But on week euro, you'd start to breach us, and particularly John, EM doing poorly today, ADXY about ready to go through new weakness, on and on. Foreign exchange is what matters to me right now.
And I think Jordan put out a call earlier this week looking for parity on
Oh,
euro
I didn't
dollar
know that.
in the
Thank
near
you. I
term.
did not
So
know that.
Looking forward to catching up with
I
you.
was singing Walk Like an
You've been
Egyptian,
busy,
which is the
Thomas.
last
Okay.
time. Whoa, way-oh, way-oh.
Oh, dear Lord.
Can you keep this up for 2 hours?
There's been that many
If I was at
pullbacks,
home,
John,
if I was
worse
at
than the
home,
gloom
I
right
would
now.
Stay tuned just to see if you could keep this up. For 2
Stay
hours.
tuned for 2003.
When the Bramo pulls you off set, it kills your mic.
I think that's my job.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The stage is set for the European Central Bank to raise interest rates this month for the first time in more than a decade. Inflation in the Eurozone rose higher than expected to a record last month. Consumer prices jumped 8.4% from a year ago. Once again, they were driven by soaring costs for food and energy. China's President Xi Jinping defended his crackdown on Hong Kong's pro-democracy movement. In a landmark speech marking the 25th anniversary of Chinese rule, Xi said the former British colony should focus on its economic development. He said Hong Kong has entered a new stage of moving from chaos to governance. North Korea is blaming its coronavirus outbreak on what it calls alien things, such as balloons sent across its border with South Korea. A government agency in Seoul rejected that claim. North Korea reported in May that it had first confirmed COVID case. Health officials elsewhere said as early as 2 years ago, the virus had already made its way there. And China Southern Airlines has agreed to buy 96 Airbus A320neo passenger jets. The list price, $12.2 billion, although discounts are generally given for large orders. China Southern will begin receiving the planes in 2024. And the college sports world has been rocked, and it may only be the start. UCLA and Southern California have agreed to leave the Pac-12 conference and join the Big Ten. That is a predominantly Midwestern league. The move comes as the Big Ten is about to sign a giant TV contract. The shakeup could lead to more movement of schools in the so-called Power 5 conferences. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
I think we should have started a bit earlier after the joint declaration, certainly, to try to put in place a bit more scaffolding to protect people's clamber towards greater freedom.
Things haven't gone the way that he hoped for, that's for sure. Christopher Pannon there, the former governor of Hong Kong. We'll get to that story in just a moment. From New York City this morning, good morning with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures down 0.4% to kick off Q3. We're negative on the S&P, on the Nasdaq 100 too, down 0.5%. Yields in again for 4 straight sessions now by 5 basis points to 296.67. We're sub 3% on a 10-year. Is it over? Is the sell-off in Treasuries over? Priya Misra of TD. I'll catch up with her in a couple of hours' time. She's gone short the 2-year, Tom. She's targeting 340 all over again on a 2-year yield.
Wow.
And she thinks the terminal rate over at the Fed, wait for this, has a 4 handle. She thinks they'll take it to 4%.
That's a real shift by Priya Misra.
Big time. Big time.
All through this weekend, folks, and we'll monitor this over the weekend and start strong on Tuesday as well here in America. We will pause now for Stephen Engel and for Yvonne Mann and look at the Hong Kong that is gone. It may be from my childhood in Susie Wong. It may be the magisterial In the Mood for Love of 20 years ago. There's a Hong Kong in our minds. It's evaporated. Yvonne Mann, this morning at the Star Ferry in Hong Kong. I can't fathom the emotion, Yvonne, of what's going on. Tell us your vignette, your emotion as President Xi visits.
Well, Tom, it certainly has been a sort of somber sort of day here. As you can tell, we're in the middle of a typhoon where we have seen some strong winds and stormy weather. And it really reckons back to just 25 years ago, right behind me, where this handover ceremony took place with Chris Patton, which you just aired that sound from, and also Prince Charles that came here to hand over Hong Kong back to Beijing. At the time, there was that aura of uncertainty of what Beijing rule would be, what this one country, two systems framework, how this would play out for the next 50 years. I would say those same sort of sentiment is being felt here in the last 2 to 3 years, where we have seen a dramatic change in the political environment since this national security law was imposed just 2 years ago to the day.
Yvonne, a dramatic change as people are leaving. Not what would you predict, but what seems to be the guess of what the expats will do and what the Western financial institutions will do.
And we have seen that during the handover, where we did see an exodus of people leave. People still lingering with those questions of what it would be like. And I think we have seen that certainly in the last few years or so as well. We speak to foreign chambers out there that say, yes, we have seen people leave. At this point, it's temporarily relocating, possibly moving offices, moving people to hubs like Singapore, where the borders are reopened, because it's not so much the political backdrop now or national security. What has overshadowed that has been Hong Kong's COVID-0 strategies, where borders are still closed, not just with the mainland, but for the rest of the world. So for the financial community, for the business community, this is still key. There is no exit plan, and we have seen under Carrie Lam's administration a flip-flopping of policies. We're starting to see maybe there is some signs that Hong Kong can break apart from China when it comes to the COVID-0 strategy part. Whether it is now that we're seeing about 2,000 cases a day, which is probably bringing us back to the highs of April. I would say, Tom, a couple months ago, we would have seen cinemas, bars closed, hotel quarantines times raised. We haven't seen that yet. In fact, there is local media reports talking about maybe easing more of the travel curbs here, that maybe a 5+2 sort of model for quarantine times as well. So whether John Lee can deliver on that and reopen to the rest of the world and mainland China is still going to be a key priority for many businesses out here.
Yvonne, I'm really glad you went there, because that does seem to be the tension here, especially as Xi Jinping heralds this unification of the mainland and Hong Kong, emphasizing it's important to get Hong Kong's businesses back up and running and working at their full tilt. How much is this going to be really the deciding factor of how China emerges from zero COVID, with Hong Kong as the test case?
Yes, there's been a lot of talk of that, how Hong Kong could be that testing place for China to emerge out of this COVID-0. We have sort of seen that in the mainland, of course, just this week, cutting quarantine times in half. But then you heard Xi Jinping in a symbolic trip to Wuhan talking about how doubling down, saying that COVID-0 is the most effective policy. So there's still a lot of questions about that. And given just the business community, they're still looking for a lot of answers. And for the most part, the Chinese narrative is that they've been pushing this sort of thesis that if we can solve the social, the inequality issues here in Hong Kong, that perhaps that the stability can be restored. But for the foreign businesses aspects, I think this is still the key question here. And we still haven't seen any sort of indication that Hong Kong may be ready to break apart from the mainland on that front.
The brilliant Yvonne Mann. Yvonne, thank you. Thank you very much. And I think Yvonne nailed it, Tom. A somber day for a lot of people.
Well, it is. And, she mentioned on COVID, and, John, we're living this with our Hong Kong team every day. I mean, John, we're not waking up and going, okay, how long am I in the apartment? How do I go to the office? Can I get home from the office? And that is the tension for the Western world in Hong Kong.
Tom, you nailed it on the business front as well. You can see where this is heading. Foreign companies, multinationals, are very worried about offending the Chinese Communist Party still.
Yeah.
Yet you can start to see several teams across different banks, Tom, start to shift away from Hong Kong and over to places like Singapore.
Well, Singapore's a long ways away. It's a whole different feel. I've actually done that, where you get on the plane and go down south, and it's like, well, this is not the same as Hong Kong. So what is, John? I don't have expertise here. Is it Seoul, Korea? Is it Shanghai? Does everybody go back to Tokyo? I don't.
You mentioned Shanghai, Tom. You think to the mainland?
Well, there has been a thrust for well over 30 years of trying to make Shanghai the financial capital. And I've always said it's the most New York City like New York in the world I've been in. But frankly, they've got the same COVID problems Hong Kong has.
Well, they certainly de-emphasized Hong Kong, Lisa, for a lot of people from the outside looking in.
And it certainly reduced the business activity. I just keep on going back to the COVID-0 aspect here, because we saw some PMIs out of Asia overnight, and they all highlighted this slowdown that's trickling out from China, South Korea. A whole host of the other Southeast Asian countries are experiencing this as well. How long can they continue before something breaks economically in the region and then beyond? And I do think that Hong Kong really highlights that, with all the businesses leaving and the inability to really foster growth.
Looking ahead to the data stateside as well, a little bit later this morning, 10 a.m. Eastern time, we get an ISM manufacturing print. We'll get the thoughts of Michael O'Rourke, the chief market strategist at Jones Trading, in just a moment. Your equity market shaping up as follows. We're down 0.4% on the S&P 500. On the Nasdaq 100, we're down 5 or 0.6%. The first half was all about pain in bonds, pain in equities, but right now in the bond market, we're turning around again. Yields are down 5 basis points. We've had 4 days of this, Tom. 296.30, sub 3% on a 10-year Treasury.
Yeah, and the equity levels are back as well. I take the point that the first half was grim, but I want to extend my timeline out, and I feel a little better. I don't know where I'm going to, but maybe it's 2024, John. I don't know.
Your team, Credit Suisse, Jonathan Golub to me yesterday, saying that he thinks we can get a double-digit gain in the second half.
Yeah, well, there you go.
Super constructive on earnings in a way that others aren't. I'll speak to Mike Wilson of Morgan Stanley later this morning too. Quite a lineup, Tom, in the 9 o'clock if you want to join.
It's very good. Maybe I'll stay around.
You should. Stick around. From New York, this is Bloomberg.
The Fed's looking right now at the tightening conditions and saying, yeah, it hurts. Yeah, it's painful, but this is a feature. It's not a bug. We're going to see more of it.
The Fed is willing to flirt, and other central banks are willing to flirt with recession.
Central bankers are finally being a little bit upfront about what they're actually having to deal with.
We're seeing this momentum where central banks have to go big because all of the big ones are going big.
The markets are starting to smell economic slowdown, which I think is a little premature.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
I think we can all smell a slowdown. Futures negative 0.4% from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures negative TK, deeply negative through the front half. And quote of the week from Mike Schumacher of Wells Fargo there. It's a feature, not a bug for this Federal Reserve.
And that extends out the timeline to them and also the message to get to work. And that's clearly what I saw overnight and what I see in foreign exchange, particularly weak EM this morning. 10-year yield, John, erodes further, 6 basis points down. And I'm going to go off Jane Foley there, who was brilliant yesterday, I believe it was, of the Rabobank, about have to go big. And this goes to this language, John, front load. Maybe it's front load July.
And take some pain. Tom, that pain is coming up in the estimates. We're starting to see downgrades.
Just get it out of the way.
Here come the downgrades on this economy. Goldman Sachs, Morgan Stanley, Ellen Zettner building off the work from the European team looking for a recession. They're not looking for a recession base case, Tom, but they're looking for some real weakness in this economy to come through the rest of the year.
I'm more interested, as you mentioned, did you speak with David Costin this week?
I did, Tom, yesterday.
That's good. I mean, it's, one of your properties here. I'm more interested in what the strategists say and how they adjust to the economists out there. And I'll say, John, it's a mix of opinion. I mean, I know O'Rourke's coming on right now, and he goes back to 2002. And, this is why I'm in triple leveraged all cash, because I never made it as a wise man. I couldn't cut it as a poor man stealing.
Is this at 1970s lyric again?
I couldn't cut it as a poor man investing. That's all there is to it.
Bramo's going on vacation. She cannot wait. She's itching. I'm surprised she's still here.
This is not as bad as 2002. O'Rourke is correct.
Tom, what kind of benchmark is that? The benchmarks you're picking out here, the early 2000s, 87, 2009.
I am advising people to extend their timeline and in the sweat of the moment, get away from a 4-week analysis to the next ECB meeting analysis and try to stretch it out to see when the actions now calm the market and give us a lift.
There is a difference between remaining calm. Nobody is saying go panic, right? That shouldn't be the message, versus being realistic about how volatile and how deep the pain might be in the next couple of months. Whether you want to stay the course, stay invested, et cetera, long-term advice, sure. But I'm just saying, from what I've seen, we have seen a regime shift this week, John. We saw the Fed, we saw the ECB, we saw other major central banks come out. Their foremost concern is inflation. They are going to be aggressive, and they are not going to stop in the signs of weakness. They are hiking into weakness, and that is what we're seeing.
I'm not here to provide therapy. I'll give you a range of views on the South Side right now.
Thank you, Dr.
That speaks to what Lisa has just said. You've got the views of, say, Jonathan Golub at Credit Suisse, Marko Kolanovic at JP Morgan, who believe you can get a really robust second half turnaround, a bounce back, maybe even reverse the losses of the first half because they think earnings will remain robust. You've got Mike Wilson of Morgan Stanley, who's effectively saying, Lisa, that won't be the case. The earnings pain is the next shoe to drop. It's the earnings picture, which we'll get a flavour of in the next couple of weeks, that is going to take centre stage for sure.
Restoration Hardware. Micron, the tea leaves
There we
are
go.
coming out, and the forward forecasts. Look, Tom, I'm not saying people should panic, but this is the reality. This is the backdrop. You're seeing those downgrades that the companies themselves are giving with the visibility, John, that they have.
I'll throw in the Federal Reserve there as well. And Tom, if you want the near-term, long-term outlook, take David Kostam and Goldman Sachs. Near-term, next couple of months, this Fed does not want an easing of financial conditions. He thinks there's a lid on this market, 4K. 12 months out, Glissman over at Goldman, he thinks things can improve, Tom. But near-term, TK, it's a big call
and I
to get comfortable taking risk, given what this Fed's got to do through this summer.
I'm going to push against Brammo Gloom in 2002. This is how you remind me. And, John, I'm going to note the Bloomberg Financial Conditions Index is a negative 1.17 standard deviations. That's always, in every case, stochastic. It goes down, and the institutions solve the tightening. We're seeing major tightening right now by the market.
TK, you know what the pushback is, though? That's been validated by this Federal Reserve. They want it there. I'm not saying they want to make it worse, but they're comfortable with where it is. And that's an important part of this sell-off through the front half.
John, in 2002, I got hammered like everybody else. I mean, you got to look out for the recovery.
Sure.
And that recovery came into the middle 2000s.
Tom, I hear you.
Do you hear me?
I hear you, loud and clear. Futures down a third on the S&P. On the Nasdaq 100, we're down 0.4%. Yields come in 6 basis points on a 10-year, 295. We're sub 3%, and it speaks to the weakening in the data that we've seen recently. Look out for the ISM a little bit later, 10 Eastern. Lisa will go through the data in just a moment. 295, Lisa, on a 10-year.
Yeah, this to me has really been the big move. And is it going to be a Priya Misra head fake where people start to realize the Fed is going to be more aggressive, setting yields even higher? Today, here's what I'm watching. The ECB's net bond buying program is set to end. This is from the pandemic. Amazing that it's been still going until now, given some of the inflation reads we've been getting out of the region. I'm watching the 10-year Italian yields. How much do they continue to come in with the faith that the European Central Bank can calibrate the reinvestments more directly into the peripheral regions in order to suppress some of the gapping out that we've seen over the past few weeks? 10 a.m., that is the data dump that we are all watching. U.S. June ISM manufacturing as well as U.S. May construction spending to a lesser degree. How much do we see manufacturing start to roll over in line with some of those regional reports that we've been getting, highlighting the ongoing weakness? And what does that mean, especially in light of some of the input prices? And today we get a host of U.S. auto sales, including from General Motors at 9 a.m., Toyota at 10:30. The expectation is for the number to basically stabilize around 13 million, which is well below the 17 million that we saw on average in 2018 and 2019, John.
Ramo, thank you. Lisa, great work. Looking ahead to the day ahead. Let's get straight into it with Michael O'Rourke, the Chief Market Strategist at Jones Trading. Mike, let's start here. Your words. I'm getting worried about energy and materials. Talk to me about energy.
Yeah, well, I've been big on the value trade, and obviously the key proponents there are financials, banks, energy. And of course, we've had a great run in energy. The energy policy in this country of not investing in the space has worked to the advantage of the stocks or investors. And of course, oil prices have shot up with the war in Ukraine. But now we're starting to see this economy slow. And we're getting clear signs of slowing. And again, the downside volatility that could become, tied to energy names if we see a real slowdown or a recession is going to be troublesome.
Michael, can you buy quality here? If you have a 1 year, 3 year perspective with the way some of these stocks have been hammered, they've got some revenue stability, they've got persistent free cash flows, you know the names. Can you begin to acquire those shares, or do you really have to be as gloomy as Lisa?
Tom, you heard me say, I think we're in this 2000 to 2002 episode of everything's repricing. I think Micron's a good example of where we are in this market. Micron's trading 5 or 6 times earnings. Obviously, a pretty awful guidance provided last night, but the shares are probably down, I'd say $1.50, $2. So they're digesting pretty bad guidance pretty well. So I would be looking for that, the value buffer in there where valuations have corrected significantly. And those are the type of names I'd be looking for. I still think a lot of the quality names still have lofty PEs in this market. I think that's one of the bigger problems out there.
Mike, there is a distinction between long-term faith that the U.S. economy can recover, which I think a lot of people share, and that there will be an entry point at some point, and this belief that there will be near-term pain. When is that pivot point? What are you looking for?
So that's a great question, because I think you guys touched on the issues as you were talking on the intro. I mean, the next 6 weeks, in my opinion, it's going to be the news headline battle is going to be between earnings and inflation. And I think we're going to see the inflation data all, it's going to pivot in the right direction here. I think the rest of the year, we're going to see decelerating inflation growth, although it's still going to be high, but it's going to be heading in the right direction. But then the earnings data is where the problem's going to be. Like you guys mentioned RH earlier, you mentioned MU from last night. Those are just a couple of companies on off quarters that we're seeing. Earnings season kicks off in 2 weeks. And I think that's going to see a rough summer because we haven't seen analysts really reset their forecast yet. Everyone's been hoping for the back half of the year. That's not going to materialize, and now we have to see a real adjustment occur over the summer.
Hey, Mike, great to catch up. Looking ahead to earnings with you and the worries around the energy story after a rip we've seen through the front half of this year. Mike O'Rourke there of Jones Trading. Michael, thank you. This was the week, for me at least, where credit started to take over in a more material way. The additional yield that corporations have to compensate investors over the risk-free asset. That was for you, Tom. Spreads. Spreads are wider. If you missed yesterday's programme, never mind. 570 basis points. Now, Lisa, we're through 550.
Yeah.
That gets your attention. And it's not just high yield. It's not just the junkies to junk. It's not just triple C's through 1,000 basis points. It's investment grade too. We're starting to see some movement that we haven't seen in quite a while.
And it's particularly notable because suddenly investors can actually get that yield. It's almost a 9% all-in yield for junk bonds to own them. So this would be great for people who had faith that we were not entering some sort of new credit cycle. But what does it look like if you start to see a Fed that does not use that as a linchpin to step back in? What is the real rate? And I think that lack of liquidity and not the Fed having the Fed put has been underestimated by a lot of people until now.
TK?
I'm just, I've got a bunch of TVs in here, folks, and I'm watching Mr. Macron after the Madrid meetings. John, he's welcoming a couple that took Air France from JFK to CDG, and they paid $25,000 for 2 business class tickets.
Tom, it's so expensive.
They're getting a greeting from the president of France.
I mean, I'm thinking of a lot of people going on.
It's insane.
Going to the airport for the long weekend.
Really?
Lisa, this is not actually aimed at you, although, of course, it is indirectly. Can you imagine how much people have paid for flights this weekend?
Really?
So the question we've got to ask from an economics perspective, actually, is whether you're going to see this repeat through the rest of this year.
Exactly.
I'm just not so sure these airlines will have
agree.
such a robust consumer. This revenge spend that we've seen over the last 18 months, can that continue, Lisa, through the rest of this year?
I actually can't believe that it will because people have gotten it out of their system. And anecdotally, what I keep hearing from strategists is they expect it to be a lot softer when people realize, okay, let's realize what our post-COVID reality is going to look like.
I'm not so Amanda Stein, John, from the New Jersey Devils on Air Canada, 45 minutes on the runway, 20 minutes in one of those little gate vehicle things.
And just to be clear, Bramo, that wasn't aimed at you. Tom was talking about himself.
No,
Who else is spending 20K?
25 grand
to chance to go
fly to
Paris. JFK.
Fair point.
I mean, that's not about us.
I guess I need to watch more TV during the program.
It's always about Tom. Do you forget that? It's not personal. Futures are down a third of 1% on the
I've been
S&P.
to the bottom of every market.
Keep
just
it
like
going,
2002.
Tom. This is beautiful.
It's Nickelback.
That got me. You got any left?
Nickelback's a band from Canada, John.
Are they, Tom?
Yes.
I didn't know that. What else do they sing?
I don't know. Chad was dating Avril, and it was great.
You know what the producer's going to do? We got to go. We got to go. We got to go. We're negative. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Inflation in the Eurozone rose higher than expected to a record last month. Consumer prices jumped 8.4% from a year ago. Once again, they were driven by soaring costs for food and energy. The European Central Bank is expected to raise interest rates this month for the first time in more than a decade. And global food inflation looks set to slow down. Key farm commodities such as wheat, corn and cooking oils are extending their slump to the lowest levels in months. The latest catalyst is a report from the U.S. Department of Agriculture. It raised the estimate for the area planted to corn in the world's biggest producer this year. Iran says it's ready for new indirect talks with the U.S. to revive the 2015 nuclear deal. The statement came after the latest round of discussions ended in Qatar after failing to make significant progress. Donald Trump pulled the U.S. out of the agreement in 2018. The Biden administration wants to renew the deal, which limited Iran's nuclear program in return for easing sanctions. In Russia, a trial begins today for U.S. basketball star Brittany Griner, who was jailed more than 4 months ago on cannabis possession charges. The two-time Olympic gold medalist was traveling to play for a Russian team. She could face up to 10 years in prison. The Biden administration calls Griner wrongfully detained. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
this can get worse. Because if this becomes a full-scale war between Russia and NATO, then we'll see suffering, damage, death, destruction at a scale which is much, much worse than what we see in Ukraine today.
That was Jens Stoltenberg, the NATO Secretary General, wrapping up a summit in Madrid, Spain. From New York City this morning, good morning with Tom Keene and Lisa Abramovich. I'm Jonathan Ferro. Futures negative 1/3 of 1%, kicking off Q3 and a second half of 2022 on a negative note on the S&P and on the Nasdaq too. We're down 0.4 of 1%. Yields now in 7 basis points. Almost 8. We're watching this tick for tick.
Eight.
Round it down, TK, to 293.
Thank you.
70 on a 10-year.
Thank you for correcting me.
Anytime.
You know, there we are. We are having a festive moment here, a Friday before a lovely, lovely summer weekend. And seriously, to all of you traveling by airline, by plane, our thoughts with you with the logistic chaos that's out there. In Europe, it is maybe not the festive weekend in America. Joining us together after their research at Joyoslava last night of the Veuve bottle fee of $244 together, Anne-Marie Horton and Maria Tadeo joining us in Madrid. We can make jokes about it, but the fact is there's a war going on. It really came home to me in Francine Lacroix's panel how subdued Christine Lagarde was in addressing war. Maria Tadeo, as we begin July, what is the debate, the distinctive debate, about all the players you know and Mr. Zelensky in Kyiv?
I think there's two big things here. Of course, one is the energy situation. I think for the Germans, they really worry about this potential cutoff. And once you do that, you're going to unleash forces that nobody can model or control. I think the other one, and Anne-Marie, you probably got a sense of this too, is how will this end? What is the end game? And they're in a difficult situation here, Tom, because they don't want to pressure the Ukrainians. That is what we hear all the time.
Right.
President Zelensky is democratically elected. This is a sovereign country. But when will it end and how long will the war go on? If you talk to the Ukrainians, and this is so important, they would rather just keep fighting, not concede an inch to Russia.
Anne-Marie, what is the end game for President Biden, who must commit U.S. troops to the Finnish border?
I think he made it pretty clear yesterday when he was asked about how much longer Americans can expect with a premium on gasoline, which is going to be pretty crucial for this upcoming weekend, of course, July 4th, where you have a massive amount of Americans taking to their cars to get to barbecues and likes. He said, for as long as it takes. So you have seen American officials, especially in public, say nothing about Ukraine without Ukraine, so really leaving it to him. But what Maria is getting at is a lot of European leaders, especially Germany and France, have hinted that they'd be more open for potentially pushing for a negotiated ceasefire. Because when you look at what is going on at home domestically, for every leader that has gathered, whether it's the Bavarian Alps or here in NATO, it's inflation. What did we get today? A euro print, record inflation. Spain, 10%. France going up. These are issues that are affecting all of these leaders, and the war has just exacerbated them.
And to that point, I mean, Maria, weigh in on this. We talked about this yesterday about the potential gas crisis facing Germany, particularly heading into late July, when we really learn how much of the gas supplies are going to be brought back online from Russia through Nord Stream 1. How much is there a discussion about spending money to offset some of the higher oil and gas prices for German citizens? How much willingness is there, given especially some of the frugality that this nation has been famous for?
Yeah, and also that's a very good point, because we've seen, and that was to me the real takeaway from the G7, is that they cannot agree on the oil price cap. They talk about it for weeks and weeks, but when it comes to actually delivering on that, they're not able to do it. Macron was really trying to get this global coalition. We have pictures of him with the Indian leader, but he's not able to get it done either. When it comes to the Americans, they're not able to get it done either. So that solution is not going to work. I think for the Europeans right now, what they focus on is the storage. They say we have 2 months, and really this is a fight against the clock to get this done by September, be in a good shape. When it comes to the winter, you have 2 months in which your storage is full. But we should really stress, and you hear that already from Deutsche Bank yesterday, they were very clear on this, if this gets cut off, be it for a week, a month, the impact that it would have on the German industry, the Italian industry, would be huge. The economy goes into a recession by the end of the year.
Let's get to the important stuff, guys. And I promised you we'd get to this. How's the nightlife in Madrid? Who wants to answer?
I'll leave it to the host.
No, I have pictures actually that can make or break a
There's
career,
evidence.
but I keep them for myself for the right. Pharaoh got some of them at 2
You
a.m. in the
messaged me
morning,
late
so I
last
think that
night. I
answers
got
the
a load
question.
of messages from you, Maria. Should I play some of the music from the club, Tom? This is what
I don't want to open up.
I've got
Listen, I don't
Anne-Marie
wanna-
dancing to this.
I don't want to open that conversation.
What song is that? What is that?
Tostito, John. It's Tostito.
It was fantastic, Tom. You should
I
see the
think,
video.
Like I said,
Maria,
How much is that worth
it's a
now?
J Balvin, I think, isn't it?
Yeah.
Maria, I want to cut in. I think it's really, really important. Madrid is the cool place to go right now. Everybody's talking about it. What is Madrid like now versus 10 years ago? What's changed there?
Look, I think it's a very good question. It really has changed as a result of all the political drama that we've seen play out in Barcelona, and that's the ultimate irony of this. Barcelona was the international capital for Spain. A lot of that has shifted because of the political tensions that we've seen play out. To me, it's the ultimate irony that Madrid has become now what Barcelona wanted to be 10 years ago, and I wonder, is that going to be rebalanced at one point? I think it should be, because it will really help this country rebalance the power between the two of them. I think it's extremely important for this country to get to a point where we're both on the same page.
You two are some of my favourite people in the world. You've absolutely crushed it this week. To both of you, thank you very much. To Anne-Marie, to Maria Tadeo from Madrid, Spain. TK, just awesome, the both of them, as always.
The team over there did it, led by Francine Lacroix, who made global headlines with that panel. But, you know, what this is about, John, is going to all the countries. And Anne-Marie Horton did this before she was relocated to Washington. John, it's not about just one story, very different than America. You got to go visit them all. To me, the focus is on the Baltic states and Scandinavia. And, you know, maybe that's just an affectation to get away from all the other agony to the south.
For me, I'm just jealous that they get such great gigs, Lisa, because
we get
back in my day, I had to go to Frankfurt and Zurich. Frankfurt
I've
and
got
Zurich.
I know, those are not exactly the same kinds of...
to Madrid and everywhere else.
John, Lisa's going to Whole Foods on the Upper West Side, and you know,
that's
going
Bramo's
down to
vacation
50,
this weekend.
Let's not get too ambitious.
See if she can get that far. Let's see if she can get that far
Exactly.
trying to get to the airport. With Lisa Abramus and Tom Keane, I'm Jonathan Ferro. Your market looks like this going into a long weekend stateside. We're negative 1/3 of 1%. And just look out bonds. We're down 8 basis points on a 10-year to 293.54. Almost at 350 just a couple of weeks ago, and since then we have backed away as this data has started to come in a little bit weaker. More data later, we'll talk about it. Stateside from New York, this is Bloomberg. Kicking off the second half in Q3 with your equity market lower. On the S&P, we're down 1/3 of 1%. On the Nasdaq, down 1/3 of 1% also. And looking at the credit market, the additional compensation corporations need to offer to investors over the risk-free asset. Credit spreads a whole lot wider. We're through the wides of late 2018, pushing 570 basis points. It's notable. The most important part of that, though, is that this Federal Reserve is not for turning compared to what it was doing back in late 2018. Does that mean there's more pain in store for this equity market? Your Nasdaq down about 1/3 of 1%. Your Russell down 0.4 of 1%. Here's the move that gets my attention. For the front half of this year, we've talked about pain in equities, pain in bonds. Right now, bonds rallying, 2s, 10s and 30s. Look at the move at the front end. Down 9 basis points on 2s. On 10s, we're down 7 to 294. You start to get comfortable with this idea, Tom, that the data starts to weaken and yields come lower, that the Fed can't do as much as some people think. Priya Misra of TD is pushing right the way back. She says, get short 2s. She's looking for a move to 340. And she thinks, Tom, this Fed can go to 4% on Fed funds. That's a big change for Priya and the team.
It's a big change for Priya Misra and what they've done there. Mark McCormick at TD, of course, with a great call on a resilient dollar. John, I would just say over this long weekend in America, we're going to publish into next week all sorts of changes, and particularly after the jobs report. John, if we don't see a crack in the labor economy, how will that change this mix?
How will it change the front end of this yield curve too? Look out for the ISM a little bit later. We look coiled. Can you imagine if we get an upside surprise there? What happens here? not saying we will get one. Based on what we've seen in manufacturing stateside from the regional Fed prints, it's been pretty ugly so far. I want to finish on Europe, just briefly. Tom mentioned that resilient dollar. That dollar's been strong. Euro-dollar seen the biggest quarterly move to the downside that we've seen since late 2016. Remember the Trump effect? All that talk about a strong dollar, all that fiscal spending, all of that good stuff. Different this time around. It's about euro weakness in a monster way. Euro-dollar 104.50. Upside surprise on inflation. The idea that the ECB might have to do more. Core was a little softer. Maybe it doesn't change things too much. But this is the story for me, Tom. Recession is becoming the base case for a lot of people, not in America, but in Europe. And for that reason, Ellen Zentner and the team call a recession at Morgan Stanley in Europe. And for them, they have to respond here stateside by downgrading their growth forecast, Tom. We saw it from the GDP numbers down at Morgan Stanley. We saw it from Goldman too.
Yeah, my issue is that you got a U.S. 10-year of 3%, the Italian 10-year of pretty much the same, 3.20%. John, you got $8 a gallon gas in Italy. The math doesn't work.
Hey, it hurts, Tom.
It doesn't work.
And as you've pointed out, the labour market's a different story too over there, Tom, compared to the United States at the moment.
Brilliant.
We're done, aren't we? That's the cross-asset price action. Let's move on. We can get you some movers, some single names. We can do that with Lisa. Hey, Lisa.
Hey, John. I want to talk about that coil that you were talking about with respect to whether the Fed will push back against a market that is pushing against it, basically saying that we don't believe you'll be able to go that far. And perhaps it's because of the disinflation forces coming from the likes of Micron, reporting earnings yesterday with a concern of an oversupply rather than an undersupply of computer chips. This is amazing considering how undersupplied the market was just 2 years ago. Remember, everyone was going out, buying devices, buying everything under the sun to stay at home and watch programs. Not doing that anymore. And you've heard that from the Taiwan Semiconductor company as well, that basically you're getting fewer orders from some of their biggest clients because people are not going to buy as many smartphones. This is a concern, and you're seeing Micron shares down more than 4% in pre-market trading. Taiwan Semiconductor down nearly 4%. NVIDIA, which we saw beaten up yesterday as well on the Bitcoin woes, down 1.3%. I'm watching this space very closely as a potential tea leaf for the rest of the earnings season. I'm also watching the airline industry because I am personally invested in this right now, and also because we are talking about the incredible amounts of travel this weekend and the incredible amount of turmoil that we can all expect if we were so wise to decide to head to the airport this weekend. Delta Airlines up 2% after a pretty unwelcome first half of the year. United up basically flat. And American Air up 0.4%. John, how much can they continue to gain given what we have seen? You raised this question earlier. I think it's a good one given that we've all spent what we can on travel.
Well, you're living it with Delta, and you know how expensive it has been. And Tom, we're all talking about the same thing, aren't we? Can you repeat the act through the rest of this year? Lisa, the revenge travel, the revenge spending, all of that stuff, Lisa. I just wonder, can that go on through the rest of this year?
You know, I personally have heard anecdotally that it is softening. Tom, perhaps you've got another take.
No, I don't. I think I saw a headline. I think it's American Airlines, can't remember, offering pilots a 17% pay increase. That's the only way they're going to fix this, is they've got to pay people more to get them in the door.
Well, Tom, as you know, though, it's not just about the price. If people have dropped out of the workforce and you can't get them back, the onboarding process for this industry, for things like security passes, for things like training, it's a big deal, Tom. It takes a long time.
I don't know. I did a short flight, John. I think the pilot was 18 years old. You know,
what flight was that?
I can't remember. They're making like a cocktail waitress, salary. I don't get it. I don't get the industry.
Would you want to share what flight that was?
Oh, it was, it was.
Is that one of those private islands in Hawaii?
No, it was a Gulfstream.
It was the Gulfstream.
It's a canal street.
She's living a different world to us, isn't it?
Let's move on right now. Leslie Falconio joining us, head of taxable fixed income strategy at UBS Global. There is less wealth management. Leslie, what a brutal first half. I don't want to look back. Total return, Bloomberg index down 15%. What do we do now? You have clients, institutional and high net worth. They have a negative monthly statement, a negative quarterly statement. What is the to-do right now to reallocate?
Well, you're absolutely right. Most of those negative total returns, as we know, were the headwinds from rising interest rates. And for the second half of the year, we're looking for that headwind to be much less. But although we also think that as the economy is pricing in, growth is going to slow. So we've been a little bit more on the defensive or cautious side. We've taken sort of that cash liquidity and put it into things like, short end corporate markets, we're doing up in quality. But now you're really in a position where, although it's been very painful, you have the ability to earn, yield, right? Plus spreads have widened. So there's a lot of cushion there. So we do think the second half of the year will be much better than the first.
Is it a once in a lifetime opportunity?
Well, I mean, listen, look, when you look at some of these dollar prices, particularly in the long end, that have seen some of these in the corporate index before this rally that we're seeing right now, these are at sort of these historical lows. I think it's too early to say sort of a once in a lifetime opportunity. And given the fact that volatility is so high and liquidity is so low, we are a bit cautious with extending too much our interest rate risk. But in terms of the dollar prices that we've seen, some of these long end corporates and the indices have never seen these dollar prices before. And obviously, as you move to par, that's a huge, tailwind to your incremental return. So we do think that the second half will be better. Whether it's historical yet is yet to be seen.
Leslie, how much of your call is pinned on this idea that the Fed cannot go as far as many people think, and as far as they're saying they're willing to go? And this really is edified by what we're seeing in the bond market, basically saying we don't buy it based on the economic fundamentals. Is that your call also?
Well, the market thinks now only about a peak of about 3.3 for the past couple of days as it's sort of shifted from inflation to recession. We don't think that it's highly likely that they go to 4% in Fed funds rate. We do think that'll be, a little bit too much of a catalyst to the economy. But right now, the market is really corrected with a 3.35 March peak and then almost 60 basis points of easing in the second half. We still think the Fed will most likely do 75 in July, just as a precaution. And we don't know really what's going to happen over the next several months. But we are a little bit less than what the terminal rate of the Fed is pricing in, which is around that 3.8 level.
So Leslie, how much would that change your call if the market is not right and that the Fed does get to 4%, as Priya Misra over at TD Securities thinks? How would that change your belief in a firmer second half?
Well, it would change in the sense that obviously the yield curve would invert, but we have this up in quality kind of theme on regardless, because we do think the economy slows in the second half. That is really the key. Doing up in quality in terms of agency MBS. In that kind of scenario, if they go to 4%, we're obviously going to have a fairly large, in our belief, an inversion in the yield curve. I think it depends on how sustained that is, but I think being a little bit more defensive and an up in quality theme really prevail in that environment.
Leslie, thank you. Wonderful to hear from you. Leslie Falconia there of UBS Global Wealth Management, working through some of these issues. And one of the big issues this week has been in the credit market. Tom, we started the show this morning by asking, where's the tipping point? Where is the tipping point in this credit market? If it's not 550, if it's not 570, where do credit spreads get to that it starts to bite and the conversation at the Fed begins to change?
I'm going to defer to Bob Michael on that. How do you know when to buy the dip on price in bonds? I don't know the answer to that, John. It's
with that
wrapped
in mind,
up in
Tom,
Fed speak. It's wrapped up in economics. I really, you say to me, where do you buy the bottom in Amazon down 85%, whatever it is, and we can blather on all day. I don't know how you do that in bonds.
Is it the Fed that turns around, Tom, or is it the investor that turns around and says, let's buy?
I don't.
To your point.
I don't know.
What do you make of that, Lisa? Do we reach this tipping point where the Fed has to make a bit of a pivot, or ultimately is there enough money out there that have been waiting for spreads to widen for a long, long time, waiting for interest rates to get back up in line with what some people might argue is in line with fundamentals, and they want to start buying it?
Okay, so I'm smiling because I don't know the answer, and I've been struggling with this with myself. Because on one hand, if the economy slows sufficiently, that actually presents a credit risk to some of these companies over the longer term to refinance themselves, but it also allows the Fed to take its foot off the pedal in terms of how much it raises rates. But if you have the opposite, where basically the economy is strong, then the Fed keeps going, and then you have to reprice the entire structure. Either way, it's going to be a really rocky pace, which is the reason why so many people are going into investment grade, saying that will be the area that will hold in tight no matter what.
Part of the reason we're seeing some renewed weakness in equities as well is just an acknowledgement of what's developing in the credit market here, both in the secondary market and with what's coming to market in the primary market?
It's two sides of the same story, which is that people are worried about growth. And when you're starting to worry about growth, there is a fundamental reason that people are going to have to charge more in terms of the premium from companies that may not pay them back. That risk of not getting paid back becomes that much more real, especially if the baseline financing costs are that much higher.
I should probably rephrase what I said. rather what isn't happening in the primary market
John,
right
I
now,
wasn't
because there's not much
focused.
supply at all. Go on, Tom.
John, I wasn't focused there. I was looking at Delta Airlines. They offered passengers $10,000
Not to
delay
fly.
their flight. I think today Bramo ought to hold out for $15,000.
What would get it done, Lisa?
You know, 15.
You got a number in mind?
Be tough,
You know,
Lisa.
Have you got a number in mind?
Sure, I'll put out a number.
Okay.
How about let's double it?
You'd want it, it's got to be 20k.
Yeah.
20k to mission. That's how important this vacation is.
It
to you.
is.
Absolutely.
That's very cool. Family means the world. doesn't
Family
it?
He's going on
There we
halls.
go. It's more important than money. It's a nice position to be in.
Halls.
It's beautiful. I like that. Isn't Lisa great?
Oh my God.
How does she get
I
3
love
weeks
Bramo.
off and we don't?
She's only got a week, Tom. She's going to be back.
Oh, okay.
Made sure of that. Futures down 0.5% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The stage is set for the European Central Bank to raise interest rates this month for the first time in more than a decade. Inflation in the Eurozone rose higher than expected to a record last month. Consumer prices jumped 8.4% from a year ago. Once again, they were driven by soaring costs for both food and energy. China's President Xi Jinping defended his crackdown on Hong Kong's pro-democracy movement in a landmark speech marking the 25th anniversary of Chinese rule. Xi said the former British colony should focus on its economic development. He said Hong Kong has entered a new stage of moving from chaos to governance. A labor contract for 22,000 U.S. West Coast dock workers is on the verge of expiring, but both sides appear willing to avoid strikes, lockouts, or work stoppages during the busiest season of the year for shipping. The current agreement between the dock workers union and more than 70 employers ends today. A deal before the deadline is unlikely. And the college sports world has been rocked, and it may be only the start. UCLA and Southern California have agreed to leave the Pac-12 conference and join the Big Ten, a predominantly Midwestern league. The move comes as the Big Ten is about to sign a giant TV contract. The shakeup could lead to more movement of schools in the so-called Power 5 conferences. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If we could bring down oil and gasoline prices, we might actually be able to avert some of the worst parts of the recession, because people would be extremely relieved if prices, say oil went down to $80 a barrel. Would be a huge relief for many.
That was Ellen Wald, the senior fellow at the Atlantic Council. 80 feels like a long way away at this point, but we're getting closer. 108 on WTI at the moment. Crude shaping up as follows. Crude positive 2.6%, backing away from the highs of close to 120, 130, 140 earlier on in the spring. Futures are negative 0.5% on the S&P. Euro dollar is negative 0.4%. Upside surprise on CPI from the Eurozone today, 8.6%. Core just a bit softer. The ECB meeting July 21st. More data stateside later. The ISM manufacturing, Tom, 10 a.m. Eastern time.
Yeah, those are big numbers, John. I don't think we've said enough about inflation hasn't come down. That's what the data says.
That's what the data says. But the market, implied rates of inflation in the market, so-called break-evens, Tom, we are starting to see them roll over. We're starting to see them roll over.
For those that survived 4 p.m. yesterday in New York, all you need to know, futures down, big deal. VIX is done next to nothing, 28 level. And John's been talking up yields here, 9 basis points in the 2-year yield, John, 2.85%.
Gets your attention, doesn't it, Tom?
Yeah.
It's 4 days of it now. 4 days of it. Treasuries up, yields lower. The data not terrific.
Bramo would say it's a toxic brew of recession worry. Will Kennedy joins now. Running all of our executive editor for energy and commodities. Will, I want to not do oil. I want to do copper here as well. Copper is malleable, and there's a thing called copper ore that China brings in by droves. If LME copper goes under 8,000, if copper rolls over, how does that relate to a China rolling over?
I think LME copper is still priced very linked to the Chinese economy. China consumes half the world's copper. And it really tells you something about the outlook, perhaps, for the Chinese economy, for the Chinese construction sector in particular, one of the single biggest drivers of copper demand. It's fascinating what's happened to the copper market. We're down right now 18% this year. Copper is pricing here in a recession. I think it's really come off. And one thing I would draw is the contrast between copper, which is pricing in a downturn and oversupply, and energy, even though we've come off the highs, remains incredibly strong.
Yeah.
Copper down this year, oil still up 44%.
Explain copper's ubiquity versus nickel. I mean, we all got upset about nickel 6 months ago, whatever, with the busted trade on the LME and that. Copper's completely different than the treatment of nickel, isn't it?
Yeah, I mean, copper's ubiquity is copper equals electricity. And as we enter a more electrified world, as we drive more electric vehicles, as we use more electricity, that means millions of tons of copper into power grids, into electric cars, into all sorts of appliances. And people are very bullish about the long-term outlook for copper. They see more demand than supply and gently rising prices. So that makes it all the more striking that we've seen this recent sell-off. All said, just under $8,000 is a pretty good price historically.
Yeah, it's the lowest going back to February 2021, but still higher than it has been over recent years before that. How much do you take a look at the gap that you've been talking about between metals, which just saw their worst quarter going back to 2008, and oil now coming down a little bit from some of the highs, but not cooling as much nearly as we're seeing in the metal space? What's the correlation here and what's the message?
I think the message here is that energy, oil, and gas and coal remains extremely supply constrained. There may be less elasticity in energy because everyone tends to keep driving even if they don't buy a new electric car, and that's probably the difference between oil demand and copper demand. But I think what it's really saying is there's a lot of concern about supply. We've got very tight spreads at the front of the oil curve. If you look at the headlines today, we've got Libya oil production down severely. We've got a lot of talk about just how much extra oil Saudi Arabia and the UAE can produce. And then we've got a lot of concern about energy demand going into the winter. Will Europe have enough gas? How much switching into oil will be? How much coal is there? And that all means you've got a lot of concern about demand and a real worry about the world's ability to make it. And a recession will help, but it won't have the dramatic effect you'll see in metals markets. And I think that's what this spread between oil and copper is telling us.
That's a really important point. I want to sit on that for a minute, that basically when we start to see the price of oil go down in the face of recession fears, perhaps that's premature based on the physical market sending a very different message. Is that correct, Will? Yeah, that's right. I mean, I think recession fears, frankly, are keeping us from being at 130, 140. The headline price in oil has been pretty range bound it's bobbed around a bit, but it's sort of been in that 110 to 120, 25 range for some time. But when we dig under the hood of the oil market, when you look at physical prices, when you look at just how hard refineries are working in the US, this week they're going at 95%. They're running as hard as they can. You're seeing the underlying demand for oil, for the time being at least, still remains very strong at a time when both the ability of the crude industry to pump that oil and the refining industry to refine it remains extremely tight. Yeah.
I thought you were done. We've got to go. Will Kennedy,
no,
thank you. Of Bloomberg. You're awesome anyway. I love you, buddy. It's been too long. Thank you. I missed my moment there, didn't I, Lisa? Give me a break. I get things wrong sometimes.
There's one. All
right. I wanted to bring you this. I was keen to bring you this, okay? Forgive me. Neil Dutter of Renaissance Macro put this out on Twitter moments ago. It's about flights. He said the following: all the news about flight cancellations ahead of the July 4th holiday has not kept folks from searching for flights. Goes on to say, search interest is about flat relative to the same day 3 years ago. And the international search story has been particularly strong of late. The international search story, Tom, as you know, has really taken off over the last few months.
I'm going to go to Hotsius, even with the Goldman Sachs markdown, saying, look, it's a fully employed America. Chairman Powell said it's a strong economy in front of the Senate. And John, the heart of the matter to me is Claudia Sahm in her labor analysis saying, how do you have the gloom in a fully employed America? We have to wait to see labor crack. It hasn't.
The problem with that, though, Tom, and Lisa, weigh in, because I know you've got thoughts on this. If you wait for labor to crack, in the market at least, it's too late.
Let's put this into context with Neil Tutta, who has traditionally been very much a bull on the economic outlook and frankly on markets. He actually came out a couple days ago and he said, I've turned cautious on the economic outlook, a place I don't normally find myself. He said this is, and on Twitter, this is a tough one professionally, but if there is a time to hit the alarm bell on the economy, I think this is the time. So yes, perhaps not as gloomy as some might go, but still a notable shift for yet another bull.
Or notable to see Dutta and Bramo on the same page about something. That's for sure. I mean,
I want
that's
to be very
something, isn't
clear.
it?
And
Sure.
I'm actually on the same page with Tom that longer term, sure, there will be a pivot point back to some sort of normalcy. I'm just talking about what we're seeing in terms of clouds and et cetera.
Where's Damien? Like work from home, work from beach? What's Sassauer doing?
What's Sassad doing?
Is it
Ask him. I've got no
work
idea.
from Turks and Caicos?
I haven't
don't know.
spoken to him.
You know what? EM's, John,
Sure there is.
we're not doing this today. I get that. It's a U.S. morning time show.
Yeah.
EM is unraveling. That's what we're going to talk about in July.
Well, we can catch up with Jordan Rochester about the FX side of that over at Nomura. Just put out a note, Tom. Put out that note moments ago. Short sterling towards 118.
Wow. Wow.
So he's looking for
Big
parity
number.
on euro dollar, and he's
Wow.
looking for 118
He
on
never
sterling.
sends me emails.
Cable 120. I think you've got to sign up for his research, Tom.
Oh, I do.
Futures down 0.6 on the S&P.
Copper is not Nickelback.
From New York, this is Bloomberg.
Companies are not just talking about supply chains and higher inflation impacts on margins, but they're talking about demand destruction now.
In this environment, inflation will erode purchasing power to a degree.
The level of demand destruction that's actually coming through is accelerating.
Energy and food inflation are going to be the wild cards.
That view that we could see recession over the winter months has become a little bit more commonplace in the market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Bramwitz, Tom Keene, Bloomberg Radio, Bloomberg Television. It's real simple. The first day of the third quarter, and the world, John, is catching down to the World Trade Organization with 2.8% global GDP. Maybe that's too optimistic.
Here come the downgrades, Tom. We talked about it all through the week, haven't we? We've seen it from Goldman. We saw it from Morgan Stanley overnight. And here comes the move lower in Treasury yields, Tom. A fourth straight day of it. 10-year right now, 293.
Oh, 293 on the yields. The yields moving in nicely. We'll do the data check on that in a moment. But where I see it, John, is a litmus paper, a stronger, resilient dollar. And this morning, the theme is a giveaway in emerging markets. And some of that is the commodities rollover.
The dollar story has been more than strong. It's just absolutely rip-roared through the first half of this year. We've had the biggest quarterly decline on euro dollar going back to late 2016. If the first half was about the Fed, we're about to see something from this ECB we haven't seen since 2011, a rate hike. And we're going to see that, Tom, later this month, I believe July 21st. From there, how far can they push this? Because the downdraft we're seeing in economic growth, the expectations around that story in Europe, just soft, soft.
John, you and me alone next week. And what we're
In
going to
DC.
have, I'm sorry, every single Wall Street firm is working over the weekend to readjust and recalibrate on their forecast.
Are you
Every single
expecting
one.
downgrades on the economy side or the equity side? Tom?
Both. I think,
Okay.
and as I said earlier, I'm more interested in the strategists, frankly.
I'm looking ahead to the earnings too, Tom. Earnings season
That's
kicking
part
off
of the
July
equity,
14th.
yeah,
JP Morgan coming up a few weeks away.
What happened this week? What you need to know, folks, as you pile into the weekend and the 4-day work week next week, is Lisa Abramowitz's world changed. Lisa, credit changed this week.
Well, we saw real spread widening. We saw a real fear of recession getting borne out a little bit more in credit, in corporate debt. I want to talk, though, about this tension that's really taking hold, and John touched on it just then, talking about the front end, the bid into bonds that we're seeing in light of recession considerations. How much can that be consistent? We're seeing both bonds getting bid even as stocks sell off. This is a traditional relationship, but at what point does this basically say to the Fed, we don't believe you? We think you're not going to be able to raise rates as much as you're telling us that you will, as much as many Fed members say that you will, because you won't be able to. Is that right? If it's wrong, then what is the potential downside risk to all sorts of risk markets?
We give you the news as it comes out. Lindner, the German finance minister, says no more leeway for relief for consumers in 2022 budget. I guess that's a gloom headline of the day. John, let's do the gloom data check. I'll take it easy here. Futures negative 19. The VIX launched 28.7.
Negative on the S&P, Tom, by 0.5%. We're seeing the story on the NASDAQ, negative 0.7%. Ugly first half. In the second half, we kick things off with a little bit more of the same. The change, though, yields lower. Yields lower, Tom, by 7 basis points to 293.90. This is a fourth straight day of it.
And it's not spread dynamics, John. 8.37 on the 210 vanilla spread. It's really just a compression of the curve, isn't it?
And it's not just the US. I believe it's in the UK as well this morning, Tom. Yields just sort of tracking lower, down 11 basis points at the front end on the gilt curve, Tom.
We start strong this hour. Daniel Morris joins us, Chief Market Strategist, BNP Paribas. Daniel, BNP Paribas has been out front for 20 years on gauging slowdowns in the global economy. How do you gauge over the weekend to a new view into the third quarter?
Well, we're not coming up with a new view. We've been looking for not necessarily a technical recession, but a significant enough slowdown into next year that it's essentially going to feel like one. So we do see, with what you have already priced in from the Fed, which honestly, and contradicting a bit some of the comments I just heard, we think may not be enough. So if anything, the Fed hikes yet more than what you already have priced in the market, that's going to do the job. And the job has to be to slow down growth enough to get inflation down, and we know what that implies.
So, Dan, that implies tighter financial conditions. They've got a whole lot tighter year to date. Walk me through where in this market you think we've got more work to do.
Well, the real issue that all the central banks are facing is that, on one hand, a lot of their problems, if you will, would go away in terms of inflation if the situation in Ukraine improves significantly and you had commodity prices fall, if China were able to get the population vaccinated and could open up, and then the supply chain bottlenecks would dissipate. And then you'd see, I think, a really swift fall, not only in realized inflation, but then in inflation expectations. And that would do a good chunk of the Fed's job for it. But given that it's unlikely we're going to get such a benign scenario in the near term, they really do need to perhaps ratchet further down on demand to compensate for what they're not getting on some of these temporary factors.
This all calls into question, Dan, the 60-40 portfolio after it just suffered its worst start to a year ever, considering that basically it means that we're not seeing enough that's been baked into the bond market and that stocks still face losses. I mean, how much more are we going to see a reversion back to the 60-40 pain that we saw in the first half?
Well, I think it really is the timing that's going to be the key thing. I mean, what's always challenging are the transitions from one worldview, from one paradigm to the other. We're going through that right now. It's, initially, don't forget, the beginning of the year was all about the recovery from the pandemic and reopening. Then we had to factor in the war. And then I think a lot of people now have sometime next year a recession. But from here to there is where it's tricky. At this point, we are concerned about at least a further prolongation of what you highlighted, with yields potentially going up and then a hit to equities. But at some point, we do think you're going to see a more traditional reaction in the market, with a rally in Treasury yields, and then at least relatively better performance for defensive sectors within equities.
When does market functioning become a problem, Dan? And we've already seen the lack of liquidity in certain basic instruments, even plain vanilla treasuries. We're talking about liquidity getting pulled out of the system, but the balance sheet for the Federal Reserve has just started shrinking this past week, going down by $20.8 million, so not, or $20.8 billion, I should say. So still not a dramatic amount based on how much they're holding. So at what point do you start to see real dysfunction?
I don't know if I'd use the dysfunction word currently, but let's say just challenging. And already for, certainly for our credit portfolio managers, it's already difficult. So on one hand, with these sell-offs, I mean, it has at times been quite indiscriminate. Inevitably, you get yields rising for companies where we don't think that increase is warranted, and you see opportunity, but can you necessarily find the bonds that you want? So things are functioning, but certainly challenging for our portfolio managers to navigate the rough waters that we have.
Ultimately, Dan, we're all asking different versions of the same question. What forces this Fed to change its mind? What is it? If it's not inflation coming down, do you have to see enough stress elsewhere? And how much stress would you need to see? What does it look like? Can you put a number on it?
Yeah. In terms of the typical or traditional assumption of some sort of central bank Fed put, that another X% decline in equities is going to get them to stop. I mean, that's not completely irrational insofar as, of course, that tightens financial conditions already. And so to some degree does the Fed's job for it. But given where we are with inflation, given that these temporary factors are going to be there for a while, and then we have the more structural ones that to be persistent, It's really going to make it much more difficult for them this time to do that, when in the past, when inflation was low, that was the reaction that we got.
It's the biggest difficulty we've all got in this market. Dan Morris there of BNP Paribas Asset Management out of London this morning. Dan, thank you. Lisa, that's the difficulty we've all got. We've all got that. This is not 2018. It's not 2015-16. We don't have that low inflation story that gives this Fed the room, the capacity, the space to say, OK, we won't tighten as much as you thought we would. It's a different story now.
To me, the biggest pivot point of the week, and this was a huge one, was hearing that this research out of the Federal Reserve, and something that all of the central bankers were really enumerating, was the risk of getting inflation out of hand, of longer-term expectations becoming unmoored, was greater, and the potential pain was greater than the potential pain of overshooting and raising rates too far. And that highlights where their concern is. It is in that longer term, so it doesn't seem like they will pull back if inflation continues to accelerate.
It makes you wonder what the bond market's picking up on the front end, doesn't it? We're down 11 basis points on a 2-year, Tom. 284.
I'm going to call it Friday liquidity, maybe. I mean, I'm looking for an excuse, and I can't find it. John, I want to go back to what I said at the top on the World Trade Organization. And you, as you correctly state, World Bank coming in gloomy is, well, I can't say enough, John, how WTO in April looking sub 3% global GDP. That was a stunning announcement then. They absolutely nailed it. And you wonder in July if institutions are going to catch up with the World Trade Organization.
And that, Tom, is what many people would define as a global recession.
Oh, 3%. Yeah, it's been the cardinal rule for years. And that's with the 6 or 5% China. And I'm, granted, there's a huge COVID asterisk there. But I mean, it's a cliche. It is uncharted territory.
Understanding the China piece of it, Tom, I think is so difficult. What does the back half look like with China?
No one knows.
Got any idea?
Nope.
So we have no idea what the back half looks like for the world's second largest economy. Isn't that a big issue?
Yeah, I think it's a modest issue. Look at copper again. And copper, folks, for radio, I'm taking my hand and making the St. Louis arch here. I mean, it's over.
It's beautiful, Tom. It works.
Thank you. Pre-pandemic. So somebody emailed on radio and said my bow tie was festive.
It's festive.
On radio.
Someone else told me it was St. Patrick's Day at KFC.
Somebody else also
like
emailed in and said, they did they? They emailed in and said, thank God you haven't sung for an hour and a half.
Do you want to sing now?
No, I can't.
You can take us out. We've got 30 seconds.
No,
come on, just a little bit more, Tom. July 4th weekend. Celebrate.
My original banner of the morning, I'm sorry. It's gloomy, folks, but it's not 1970. It's not 1974, 1987. Those were real drawdowns.
It's not the 1930s. That makes us feel so much better,
I'm not
Tom.
singing Cole Porter.
It's not 1788.
Come on. Yield's down 7 basis points. Your 10-year 293.90. Let's call it 294. Your equity market down 0.4% from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Inflation in the Eurozone rose higher than expected to a record last month. Consumer prices jumped 8.4% from a year ago. Once again, they were driven by soaring costs for both food and energy. The ECB is expected to raise interest rates this month for the first time in more than a decade. And global food inflation looks set to slow down. Key farm commodities such as wheat, corn and cooking oils are extending their slump to the lowest levels in months. The latest catalyst is a report from the U.S. Department of Agriculture. It raised its estimate for the area planted to corn in the world's biggest producer this year. In Russia, a trial began today for U.S. basketball star Brittany Griner, who was jailed more than 4 months ago on cannabis possession charges. The two-time Olympic gold medalist was traveling to play for a Russian team. She could face up to 10 years in prison. The Biden administration calls her wrongfully detained. And shares of Kohl's are falling. The department store chain has concluded a strategic review and decided that it's not prudent to pursue a potential $8 billion sale to vitamin shop owner Franchise Group. Kohl's also revised its sales outlook downwards. And a significant step for Amazon as it pushes deeper into sports. The tech giant has secured the rights to broadcast Europe's top football tournament in the UK for the first time. Amazon will exclusively offer top UEFA Champions League matches on Tuesday nights for 3 years starting 2024 to 2025 season. BT Sports will retain the majority of coverage. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Inflation's the bigger risk because it's here. It's real. And if inflation doesn't come under control quickly, it does enormous long-term damage. Is there a risk that we have a recession? Yes, I think clearly there's a significant risk that within the next 12 months we'll have a recession. I think there's a mindset at the Fed that sees inflation as a psychological problem rather than a monetary problem.
Senator Pat Toomey there of Pennsylvania on Bloomberg in the last 24 hours. From New York City this morning, good morning. Futures negative on the S&P, down 0.4% on the Nasdaq 100, down 0.5%. Speaking to those concerns about a slowdown in growth, maybe even a recession, yields down another 8 basis points. This is one to watch. 293.17 on 10s, and we're seeing this rally, Tom, right the way through the curve, 2s out to 30s.
Pros are going to tell us there's an oddity to it, John, but I'm sorry. I'm just looking at level here. And again, I want to emphasize this is truly a compression. This is not yield dynamics, fancy hands moving around. This is a recession outlook and a fact that a lot of people are going to have to adjust the first week of July.
It's interesting to me, Tom, though, you're seeing it more pronounced in the front end. You're seeing a 12 basis point move on 2s lower to 283. If we're going to have this whole conversation about the Fed going too far and growth getting hammered, it's interesting to me that it's the 2-year that's so well bid this morning.
Housekeeping, John. Miss Bolt, best dressed woman in Bloomberg, coming in from watching TV in Paris, of all places.
Sure.
Great bow tie. Greetings from Paris.
There we go. I actually got some nice feedback about your outfit as well, Tom.
You were mentioning Colonel Sanders.
Well, I meant, KFC on St. Patrick's Day, where it's like the tan suit with a bit of green.
Yeah,
that didn't resonate?
It's a day to watch us on radio. Is what it is.
What, today?
Yeah.
Someone's calling it a Summer Friday look.
It is. It's a Summer Friday
throwback
look.
Summer Friday trading floor story is what they would like.
President Obama.
Is this what it was like on the trading floor years ago?
It was very much so. It was like what's really sad here, John. Seriously, bond market closes, John, at 2.
We're getting early close. I didn't know that, Tom.
Lisa, help me here. 2 o'clock today.
I'm not.
Ramo's long gone
be on a plane.
by that
2
point.
o'clock.
2 o'clock.
Ridiculous.
Yeah,
It's completely
2 o'clock. I'm
unfair.
hearing.
All the fancy people in beige suits get to leave early, and the staff has to stay till 2 or 4 o'clock. I hate it. I think it's just bad labor.
The fancy people
policy.
wear beige suits, just to clear this up.
They do. Terry Haynes wears a beige suit. He joins us now, founder of Pangea Policy. Terry, I want to talk about something that's not in the zeitgeist, but I think it's really important going to November 8th of this year. Everybody's talking about rhinos, Republicans in name only. I want you to frame the dino Democrats in name only. Is the President of the United States a dino?
Good morning. You'd think so by his past track record, but I think what he's busily trying to do is tack to the left and understand where the majority of his party is and seek to represent that. Not for him the old Gilbert and Sullivan line that he led his regiment from behind. But clearly, I mean, I wasn't surprised by this because you could see where the Democratic Party was going even before 2020. But he has sought to essentially do everything he can to try to keep his party together. But by and large, go to where the energy and the money is in the party.
Where the money is. Oh, stop it, Terry. It's where the money is. Help me here after Roe v. Wade and the uproar of June, where suburban and particularly suburban women are as they parse out rhinos, dinos, and the far right and the far left.
I think it's much more of an anti-incumbent election, and I think it's much more of an economy election. The stat coming from Washington that I think is not much followed on Wall Street, but it's followed greatly here, is real per capita disposable income, which has declined 20% since March of 2021. That's yet another bad sign for Democrats. I think what you have here is you're going to have a majority Republican Congress in 2023. I'd set the odds today of that at 60%, largely because the Senate outcomes are much less known. But you're still not going to have any sort of a one-party monolithic majority that clears the decks and sets a definite direction, no matter what it is. Compromise and kind of working together in the center is still going to be where the action is. Think about the gun debate and gun law as a recent example of this.
Terry, what does it say about this Congress, given the bifurcated nature, given the contention that we see only heating up over social issues and also some of the castigations around inflation, that Congress might not get done this bipartisan agreement on how to boost chip production domestically?
I'm sorry to say that, generationally, the Congress has become much more performative than legislative. And what it says to me, and has said for a long time, is that something that is viewed and talked about as an existential threat, China, you can see in the behavior of members in both parties that they must not consider it to be quite the existential threat, because a year plus after this legislation was introduced, they still don't have it done. Now, I think there's a high likelihood that the legislation gets done. Today, I'd put that at 80%, but it doesn't say anything good about American foreign policy or resolve to confront China economically, that it's taken more than a year to get to the point where we're not quite done yet.
Tricky stuff, Terry. Big challenge. Terry Haynes there of Pangea Policy, and big moves in this bond market. Can we pick up on that? Yeah. Very briefly, breaking 280 on a 2-year, down 15 basis points on a 10-year, down 10 basis points, call it 11, to 291. These are big moves. That rate cut story was kind of a peripheral story maybe a number of weeks ago. It's getting brought in. We're bringing that rate cut story in at the same time the Fed is considering hiking 75 basis points at the next meeting, Tom. These are some big moves developing in this bond market, some big calls coming through.
Yeah, this goes to that strange economic magnitude as well. John, this is a sideshow. IMF just announcing with Ghana, clearly a frontier African economy, that they're going to do a negotiation as Ghana collapses. And I'm looking at I hope I'm pronouncing it correctly, John, the CEDI, C-E-D-I, the Ghana CEDI, USD GHS is the Bloomberg signal. And I mean, it unravels, John. And again, I go to where, as you try to look forward as hard as we do, you're overcome by events you just don't see coming. I'm watching EMFX right now.
It's the S word, stress, and Lisa, we've talked about that a few times through this morning, particularly in credit over the last week or so.
And we're not back to the same kinds of levels of stress by a number of gauges as we have been in previous downturns or previous times where the Fed has stepped in. But I offer you this tension. Do you think that stocks are offering the same message right now that bonds are, with the bid in and this belief that the Fed will eventually hit pause?
Jordan Rochester's going to join this program in a moment over at Nomura. He's got some big calls. Euro dollar down to parity. Cable sterling against the US dollar. He's looking for 118. He joins us next from New York City. This is Bloomberg. I wouldn't call this a boring start to Q3 in the second half, that's for sure. Futures down 0.4% on the S&P, but these moves in the bond market get our attention. We're down 9 basis points on a 10-year to 292. On a 2-year, we're down 13 to 282, a brief break of 280. Bramo going into the ISM a little bit later this morning, 90 minutes away. It's interesting to see us trade like this ahead of what a lot of people this week considered an important number.
I don't really understand it. I'll be honest. I wonder if there's some sort of technical story behind it or some sort of idiosyncratic trading strategy gone awry or something. I don't understand why people would suddenly have conviction that a recession means the Fed will back away from rate hikes at a time where there does not seem to be any evidence of inflation cooling off quickly enough to give them faith that they can do that.
I hear you. It might go the other way. I've got Priya Misra of TD a little bit later in the next hour who thinks it will. She's targeting 340. She's put a short on. This market's pretty bullish on the front end, at least for now. Lisa, to your point, you would think that if you believe the Federal Reserve's going to keep moving, that it's not the time to buy the 2-year, but clearly that conversation has been introduced in the last week or so that we get rate cuts next year, not hikes. So that's the change. Now, TK, Bramo's got to run. I'm going to tell Bramo just to leave. She's got to get to the airport, Tom.
She does.
She's got to get to JFK.
I can still stay.
Just stop it. Just stop it.
Well,
You're done.
Kriti Gupta, and we're going to go to Kriti Gupta.
We'll catch up with her a little bit later. And can we do a phone up with Lisa on the way to JFK?
Yeah, sure.
We should do that.
No, the Lisa, the stack up at Teterboro is something there. Be sure when you get to Teterboro, the coffee in the terminal in the middle there. There's like 6 terminals.
You
whatever.
would know.
Lisa,
have no idea.
GW Bridge can be hard on the way to Teterboro. Be careful.
At least it's not going to that
as well.
airport. That's where Tom's plane leaves from.
Jordan Rochester with us right now, G10 FX
Brown.
strategist with Nomura right now, and he is going to brief us, and this is the conversation of the day. I want to go to magnitude, Jordan, and John mentioned your 118 weak pound sterling call, but is Q3 a quarter of magnitude for the major foreign exchange pairs?
I think so, Tom. I mean, risk appetite is on the proverbial barbecue, the yakiniku, as we say in Japan. Well, look, when it comes to what's going to happen in the next few months, next month is a key one for Europe. We've got the potential for Nord Stream 1 to have all of its gas supplies cut off. 60% of those gas flows are already cut off. So we're actually just talking about the last 40%. So it's not even that big of a deal now. We've already had the big move lower in the gas flows. That means Germany could consider rationing its gas supplies to industry. So that's going to affect Europe in a big way. That's why recession fears are really picking up, not just in the US, but in Europe as well, Tom. And for the UK, it stands out as the main country in Europe that hasn't done enough to subsidize the consumer, but also it raised taxes. And then third of all, it has a central bank that is, unlike the ECB and unlike the Fed, it's not really being accused of being behind the curve because it's been raising rates for longer since December of last year. So that's why we're already seeing the Bank of England toying with the idea of, well, maybe we don't need to be too hawkish because there is a growth impact. There's a consumer confidence crisis building up. And that's why we think cable will go towards 118. And I think early August, when the Bank of England disappoints us,
Mr. Kuroda,
I think they'll do a 25 basis point rate hike instead of 50.
Mr. Kuroda was not on Francine Lacroix's market-moving panel this week in Sintra. Extrapolate sterling weakness over to the magnitude of the move we're going to see in Japanese yen.
Tom, the Japanese yen's been really difficult for everyone. There's 2 or 3 things going on. First of all, when US yields go higher, the Japanese yen tends to weaken. Second of all, when oil prices go up, the Japanese yen tends to weaken. Well, now we're having US yields go lower. Now we're having risk off at the same time. That usually leads to Japanese yen strength. And we're having oil prices soften too. So I'm surprised dollar yen is being so calm on a day like this with the rally we're seeing in fixed income. But at the same time, there is a global story about energy prices in the winter coming up where LNG is going to be in big demand. And that's going to really weigh on Japan's trade balance. So short-term energy prices might be weak. It depends where you're looking, because in Europe, gas prices are not weak. They're really accelerating. So I think that's pushing up LNG prices, and that's making it quite difficult for the yen to rally in the environment that we're in, even though we're having this huge fixed income rally today.
Jordan, what a tough spot for this ECB, for President Lagarde, for euro dollar. It just feels lose-lose at the moment, Jordan. If they hike, it's a euro weakness story for many people. They anticipate a recession. If they don't hike, it's for all the wrong reasons. It's sell the euro. Jordan, is it a lose-lose situation? Can you envision a situation where this euro does get a bid, this euro does rally?
There is a way. There is a way. I mean, we're looking for parity, so I don't think that is going to rally. The view from us is euro is a sell. But there is a way, which is we find some reason collectively as a market to say global growth expectations are going to turn around. They're going to improve. When that happens, euro goes higher, always, pretty much. Euro is a pro-cyclical currency. So what could lead to that risk on? Well, it could be a ceasefire in Ukraine and Russia. We could see energy prices soften as supply hopes would improve. The other one is China. We have either a large fiscal announcement in China as they are coming out of COVID lockdowns. They might want to do that. Or they might relax their zero COVID policy, allowing more free trade of people, of commodities and so forth in the supply chain. So that could be another way of doing it. Or we see the Fed turn dovish and say, actually, we're not going to raise rates as much as we think. Well, we're seeing today a massive repricing of the US curve. But again, euro dollar is not heading higher. So I think we're in a different framework where we shouldn't be using yields to say where euro dollar is going to go. We should just be using growth expectations once again. So FX has many different frameworks. The key part is knowing which is the right one to use today. And I think it's that growth framework that is the dominant factor for the time being.
So, Jordan, with that in mind, how relevant is ECB policy to what happens with the euro?
It's definitely relevant. So, for example, we've had some hawks. The Lithuanian council member was saying we could do more than 25 basis points in July. I think that's very unlikely. But if they were to do that, you would get a short-term boost to euro. But we've had bunds go from 0% in March to, I know where they've moved today, but we went up to 180 at one stage.
Close to, yeah.
The euro fell during that period in those 3 months. So we went from 112 to 104. So higher euro yields. It's not leading to a stronger currency. So it is a bit of a lose-lose for the ECB. They're trying to stop the currency weakening. But at the same time, fundamentally, their terms of trade is collapsing. So there's a huge macro driver pushing the euro lower. And the ECB would have to do a lot more to improve things. But that would just equal recession.
Jordan, the Little Red Book is not Mao's book of China. It is Stanley Fischer's book from 1998 through the crisis, IMF Lessons from a Time of Crisis. Everybody in the middle of the first decade of this century had to read this in the game. Fischer would say, watch EM. Now, that's away from your remit at Nomura, I get, but I'm sorry. Thai baht unraveling. Indonesia ready to go through 15,000. Filipino with Marcos looking at 60. What is the symbolism to the developed institutions that EM is unraveling before our eyes?
Agreed. We've got basically short EM positions. We're pushing long dollar Philippines, for example, as a team. It's going to be really difficult for EM to rally in this environment with higher US yields, pushing up the cost of funding for everybody else everywhere. The hope was that tourism flows could support some countries such as Thailand, and that might still be the case, but we could have COVID waves offset that. But in general, if you have peripheral yields in Europe, if you have US credit widening like we are, essentially systemic stress in the credit market is building up. That is just not an environment where emerging markets, especially those with trade deficits, current account deficits, do well. That's just not going to happen. So for the time being, it's quite, from a structural perspective, given our long dollar view that we have in this quarter, I expect emerging markets to underperform.
You at 75 for the Fed this July. Is that what you're looking for?
That's it. That's right. So our team, our US economics team, has really hit the nail on the head.
They have,
with their Fed calls. I think they're going to be right for next year as well. So we have 75 coming up for the next meeting. But let's talk about what we published over the past 2 weeks. They're calling for a recession next year. They're calling for a recession this year in Q4. That's a lot earlier than other sell-side banks. That's Robert Denton, Aichi-san, pushing those views. When it comes to next year, we are pushing also Fed hikes to finish in the first or second quarters. Let's say we get to May. We get to a terminal rate of around 3.5%. And then the Fed starts to cut rates from September onwards, 25 basis points a meeting. And I think that's what the market's doing. It's moving towards the view from our US team today.
Jordan, who leads that team? We'll just give them a shout out because they've been great.
I did. Robert Dent, Aichi. Those guys have really pushed the view really well.
Awesome. Jordan, thank you, buddy. As always, Jordan Rochester of Nomura. They were talking about 75 long before anyone was talking about 75. Yeah. Credit where it's due. I'll share this with you. Tom, you might know this already. One of my favourite functions on the Bloomberg terminal, WCRS Go. Just gives you a snapshot of foreign exchange. You can select where in foreign exchange, G10, the commodity currencies, emerging markets, whatever you want. Do EM year to date, and something's going to surprise you here. I'll go through the weakness. The underperformers, the Turkish lira down 21%, the Argentine peso down 18%, the Hungarian forint down, let's call it 16%, the Polish zloty down 11%. Tom, the best performing EM currency year to date. Do you know what it is?
I'm guessing Brazil.
Close. That's number 2. The ruble.
Oh, yeah. Well, yeah. I don't
By
even,
a margin,
I don't even look at EM
as
Russia's EM. I look at them as frontier. They're like Ghana to me.
You want to call it frontier now?
Yeah, I would call Russia
You've
frontier.
Downgraded them.
It's such an odd economy. You know, the thing that Nomura does is they call all their fellow employees the Japanese thing san. You know, I'm going to miss Brahma-san here.
Brahma-san. Brahma-san's gone.
Yeah, I'm going to miss her.
She's on her way to the airport, Tom.
Yeah.
I might try and get a phoner in. A phone interview in the next hour with Bramo.
We should.
On our way to JFK. Well, that would be fun, wouldn't it?
I thought she's going to Teterboro. I'm sorry.
That's for you. We live very different lifestyles compared to you, Tom.
Can we talk about
Bitcoin? From. Please
John,
do. Go.
Bitcoin's got to get to Tuesday. And I really don't know, given the financial and regulatory interest, it's a complete mystery to me how Bitcoin gets a bid. I read this weekend of Bitcoin mining at Seneca Lake, John, which is beautiful, up in upstate New York, and they're arguing over doing mining there because they're going to heat up the water and all that. And John, I just don't get it.
Do you know what I struggle with, Tom?
They don't get
just the idea they don't get a break, that thing carries on trading through the weekend.
Yeah.
I mean, come on.
That's the point. I mean,
what time are we closing the bond market to? 2 p.m.
Yeah.
And crypto's going through the weekend.
I don't know. I got to find a new song to sing here as we go another 20 minutes.
Bonus round. I'll be with you in the next segment, so I can't wait. Futures down 0.25% on the S&P. Bonds rallying. We're down 9 basis points on 10s, 292. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Iran nuclear talks are likely to resume after President Biden's trip to the region this month. An intention round of discussions in Qatar failed to overcome differences between the US and the Islamic Republic. The 2015 nuke agreement offered Iran sanctions relief in return for curbs to its nuclear program. Donald Trump pulled out of the deal back in 2018 and reimposed sanctions. And the stage is set for the ECB to raise interest rates this month for the first time in more than a decade. Inflation in the Eurozone rose higher than expected to a record last month. Consumer prices jumping 8.4% from a year ago. Once again, they were driven by those soaring costs for both food and energy. China's President Xi Jinping defended his crackdown on Hong Kong's pro-democracy movement in a landmark speech marking the 25th anniversary of Chinese rule. Xi said the former British colony should focus on its economic development. He said Hong Kong has entered a new stage of moving from chaos to governance. And a labor contract for 22,000 U.S. West Coast dock workers is on the verge of expiring, but both sides appear willing to avoid strikes, lockouts or work stoppages during the busiest season of the year for shipping. The current agreement between the dock workers union and more than 70 employers ends today. A deal before the deadline is unlikely. Americans will buy more fireworks than last year to celebrate the 4th of July. The industry is prepared for that, boosting imports by 27%, but buyers may get sticker shock. Prices are expected to be up about 30%. Transportation costs have been a big part of that increase. Fireworks need more space for safety precautions. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The consumer's going to have a big summer. People getting out and doing all the things they haven't been able to do for the last couple of years. Over time, that cushion will get spent. And in particular, in this environment, inflation will erode purchasing power to a degree.
Well, Stephen Stanley there, the chief economist at Amherst Pierpont on this economy. If you were looking for a quiet end or quiet end to the week, quiet start to Q3, going into a long weekend, we're not getting it. We're down about 0.25% on the S&P. Got a big move in the bond market to talk about. Yields down 11 basis points. Thomas, a break of 290 on a 10-year, 289.86. And that's not the only news out there. We're waiting for news from GM. Trading halted, Tom, news pending. From General Motors. And no other information whatsoever. We're
going to do what we do, which is aggregate the news flow, and there's nothing to aggregate. I just don't see, anything on Twitter. Nada. Nothing from a legitimate source. We're not going to speculate. But it's a big deal. I'm sorry, GM, let me read it exactly. General Motors halted for news pending.
We will wait for the news. We'll see what that news is. There's nothing else much to say. Tom, I can't talk about the front end of this yield curve, down 14 basis points, 281. Looking ahead to the ISM in about an hour and 12 minutes from now, anticipating maybe some weaker data and this conversation about not rate hikes, but maybe rate cuts in our future.
Fractional curve steepening I'm going to go with, but mostly it's just a yield compression, and equities haven't played. It'll be really interesting to see after 10 a.m. off that key economic data.
I'm with you, Tom. That's such a good point. Equities haven't paid. They haven't played at all, considering what we're seeing develop in the bond market.
Yeah, and we'll have to see. We'll continue to watch General Motors. Right now, what we're going to do is cover airlines here and all the uproar. And we're not going to do the gossip that's out there. Everybody's having a field day with us. We're going to try to get some clarity thought. We are going to go to Nashville, Tennessee, which is the franchise of Raymond James. But first, we've got Kriti Gupta with us at LGA. It is a spanking new, hugely successful rebuild of LaGuardia, worst airport in the world, according to any number of studies. And boy, have they turned that around. Kriti, it's not the panic of 2 days ago, is it?
It's not the panic of 2 days ago, Tom. I think the story here is going to be the trade-off between the airline story and the gasoline, the driving story. I mean, you talk to people here, even flight attendants here, and they're saying, well, all the rush, all the chaos, it happened earlier in the week because everyone already got out of town. If you actually look at what the research is saying, AAA actually said that this weekend, it's going to be the slowest holiday weekend going all the way back to 2011. It's going to be the busiest holiday weekend for driving, the second busy, I should say, going all the way back to 2000. So it's very clear that people are looking
looking at airfare, they're saying it's too expensive and they're driving instead.
Critty, one quick question here. You've got all eyes all the time on your Texas as well. What's the anecdote you get of DFW?
Well, I'll tell you right now that in the last about hour since we've been here, we walked in, no flights were canceled. We checked again an hour later, 3 flights are canceled. 2 of them were out of DFW Airport. And really what it tells you anecdotally, Tom, about a month ago I was there, DFW is an international airport. It's also a major domestic hub. So the traffic, the flight attendant shortage, the pilot shortage, it's almost magnified in that particular spot.
Critty Gupta, thank you so much at LaGuardia in New York. Now we go to Nashville. Savi sits with us, Airlines Managing Director at Raymond James. You're writing for Tuesday, Savi. What are you going to write about Tuesday about this airline chaos?
Thanks for having me. What I would say is, from a cancellation rate, operationally airlines are having a harder time, but they have proactively taken down schedules. So what we've been writing has been consistent, I think, for the last several weeks, and it will be consistent on Tuesday, which is that operationally, airlines would love to fly more. There's definitely more demand than there are flights today. Even with maybe some consumers choosing to drive, there's just still too much demand for the amount of supply airlines can put out there. But they have taken it back because they want to maintain decent operations. And if you look at cancellation rates, we're probably trending only 1 percentage point higher than it was pre-pandemic. So they're doing enough ahead of time to try and offset some of the pain that comes with the current operational environment.
Savi, you're speaking to something that I don't think gets talked about enough: the difficulty of ramping up capacity in this industry, even if you want to. The amount of regulation that requires the certain amount of trading, how long it takes to onboard people, to get them to operate in the airports. Can you run through that for us, Savi, just how difficult it is to build out capacity and build out an employee as a force, a labor force for some of these companies? It's just tremendously difficult, isn't it?
It is. And last year you saw, across the ecosystem, airlines having problems, not just airlines, their partners and airports as well. I think this year, a lot of that is under control. They've learned lessons. They've hired ahead of time. But the biggest bottleneck is on the pilot side. We've had a lot of pilot retirements during the pandemic when you didn't know if demand was going to come back. And now that demand has come back really strong, you're trying to hire and put pilots in the cockpit as quickly as possible. But it is a longer time horizon. And so that is like the key bottleneck here. It's not necessarily pilot supply yet, though that is a concern longer term. But right now it is about class sizes that are 3 to 4 times bigger than they used to be pre-pandemic, and trying to get those pilots through and into the cockpit in time to fly the capacity.
Savi, I've got 30 seconds on the clock. Clearly, they are reluctant to build out capacity, not just unable to build out capacity. There is a worry now about whether this so-called revenge spend on travel persists through the rest of this year. What's baked into your numbers on that one?
Yeah, we're assuming a slowdown, but the key here is because capacity is so much below demand, even if demand comes down, maybe that just gives you some relief there. So yields might be lower, fares might come down, but generally we think it's still a strong environment for airlines, even with some pullback here in demand into the fall and maybe into next year.
Savi, awesome. As always, Savi Sither of Raymond James on the travel industry, the airlines. TKGM, headline just out. Yeah. They see second quarter net income at 1.6 billion to 1.9. Just seeing that number across the Bloomberg right now.
This is in real time, folks. We'll do much more on this on Bloomberg Radio and Bloomberg Television here. I've just brought up, and again, all of this at the speed of modern digital. John, this is the 8K form. It's a substantial form, and it's loaded with numbers, and we'll have to go into the 1, 2, 3 major paragraphs. Again, semiconductor shipments, John, and other supply side disruptions, 95,000 vehicles in inventory.
We'll talk about it in the next hour. On the next hour on Bloomberg TV, Mohammed Al-Arian, Mike Wilson, Priya Mitra, Luke Cower. What a lineup we've got to get you through the first trading day of Q3. From New York City, this is Bloomberg.